Private Equity Grandmasters. The winning playbook mantra of PE legends. Sarah Geithner, Senior Family Office Investor. Introduction. What makes a grandmaster? The private equity industry loves visible measurements. It ranks firms by assets under management, capital raised, deal value, realized proceeds, internal rate of return, and multiple on invested capital. The measurements matter. They allow investors to compare institutions and help explain why certain firms gain access to larger opportunities. But the largest number does not identify the wisest owner. A fund can become enormous because prior funds performed well, because a brand became trusted, because institutional investors needed exposure, or because distribution expanded into new channels. It can also become enormous because the industry entered a fundraising cycle in which capital chased scarcity. Size is evidence of confidence. It is not proof of judgment. The grand masters of private equity distinguish themselves in 5 ways. First, they see structure inside confusion. A weak investor sees a company with many problems. A strong investor separates temporary disorder from permanent impairment. She identifies the few variables that determine the outcome and refuses to be distracted by the rest. Second, they understand that price is a form of risk control. The future is unknowable, but the entry price decides how much perfection the future must deliver. Great investors do not need certainty. They need enough margin for error to remain solvent and rational when reality deviates from the plan. Third, they know the difference between financial leverage and organizational leverage. Debt can improve equity returns, but people, systems, incentives, technology, and culture determine whether the business can carry it. The greatest firms built operating capability because they learned that a spreadsheet cannot execute a transformation. Fourth, they manage time. They move quickly when an opportunity is perishable, but they are patient when value requires years to mature. They understand that urgency and impatience are not the same thing. Fifth, they build institutions larger than themselves. A brilliant individual may complete a remarkable deal. A grandmaster creates a firm that can produce sound decisions after the founder is gone. This book examines private equity through stories because stories reveal the sequence of judgment. The numbers tell us what happened. The story shows what people believed before the outcome was known. At the beginning of every investment, there is a thesis. At the end, there is attribution. Between them lies the truth. Prologue. The $55 billion question. The announcement carried a number large enough to stop the industry in its tracks. $55 billion, not for an oil field, a railroad, a utility, or a chain of factories. The target was Electronic Arts, a company whose most valuable assets existed in code, characters, communities, licensing relationships, creative talent, and the memories of players around the world. On September 29, 2025, Electronic Arts announced an agreement to be acquired by a consortium consisting of the Public Investment Fund of Saudi Arabia, Silver Lake, and Affinity Partners. The all-cash agreement valued EA at approximately $55 billion in enterprise value. Shareholders were to receive $210 per share. The financing commitments included roughly $36 billion of equity and $20 billion of debt, with $18 billion expected to be funded at closing. As of the preparation of this edition, EA continued to describe the acquisition as pending. The proposed transaction was extraordinary not only because of its scale, but because of what it said about the evolution of private capital. The classic leverage buyout was associated with tangible assets and predictable cash flows. Investors sought businesses with factories, stores, hotels, hospitals, consumer brands, or distribution networks. Lenders could inspect collateral. Operators could reduce costs. Buyers could model demand with a degree of confidence. EA belongs to a different economy. Its franchises are valuable because customers choose to care about them. Its recurring revenue is supported by engagement, but engagement depends on quality, community, competition, and cultural relevance. A disappointing creative decision can weaken a franchise faster than a neglected factory loses capacity. A talented employee can leave with knowledge that does not appear on the balance sheet. The consortium was therefore not merely buying cash flow. It was buying a system that must continue producing imagination. This creates the central tension of modern private equity. Capital can provide patience, strategic focus, technology investment, and freedom from quarterly market pressures. It can also create fixed obligations that do not care whether creativity arrived on schedule. No debt agreement can order a great game into existence. No model can guarantee that a beloved franchise will remain beloved. No investment committee can reduce culture to a cell, and yet the transaction demonstrates how far the industry has traveled. Private equity began as a relatively obscure practice pursued by small groups of financiers buying overlooked companies with borrowed money. By 2026, firms such as Blackstone, Apollo, Brookfield, KKR, Carlyle, EQT, CVC, Bain Capital, TPG, and Thoma Bravo operated across continents and strategies. Several managed hundreds of billions of dollars. The largest alternative platforms managed more than $1 trillion. Scale offers real advantages. Large institutions can assemble specialized teams, access financing, recruit executives, invest in technology, and survive periods that would overwhelm smaller firms. They can build capital markets operations, credit businesses, insurance relationships, data capabilities, and networks of operating advisors. Scale also creates pressure. A small fund can wait. A giant platform must deploy, raise successor funds, preserve fee streams, retain professionals, and demonstrate that its machine deserves more capital. When a firm has billions available, inactivity begins to feel like failure. That is when size can become an enemy of judgment. The EA transaction stands at the entrance to this book because it contains nearly every question that defines private equity at its highest level. What is the asset really worth? How much of the return will come from operational improvement, growth, financing, or a future buyer's valuation? What happens if the central thesis is only partly right? How much debt can the business carry without losing the freedom required to create? What responsibilities accompany control of a cultural institution used by millions of people? And what remains after the investors leave? A stronger company? A more capable management team? Better products? A weakened balance sheet? A damaged culture? Or merely an attractive return? Private equity is often presented as a technical discipline. It is technical, but technique is not its deepest layer. The deepest layer is judgment under conditions of consequence. A transaction receives its headlines when it begins. Its truth is revealed only after ownership starts. Part 1. Before the Empire. Chapter 1. Before private equity had a name. Long before private equity occupied glass towers and recruited armies of analysts, it existed as a simple act of conviction. Someone believed a business could become more valuable under different ownership. The earliest form was not branded as an asset class. Merchant banks financed acquisitions. Families backed managers. Industrialists bought competitors. Entrepreneurs borrowed against personal assets to acquire the companies that employed them. The legal structures differed, but the wager was familiar: take control, accept risk, improve the enterprise, carry the financing, and wait for value to emerge. Modern private equity surrounds that wager with complexity. Investment memoranda can run hundreds of pages. Models contain base cases, downside cases, acquisition scenarios, debt schedules, tax assumptions, and exit sensitivities. The work is useful, but it can obscure the question at the center. Will this business become more valuable under our ownership, and do we understand why? The first generation of buyout investors had fewer tools. They could not instantly access industry databases or monitor performance through digital dashboards. They relied on conversations with customers, suppliers, managers, and lenders. They watched inventory. They inspected plants. They studied cash conversion and asked whether the owner was tired, distracted, or trapped inside a conglomerate that no longer cared. Because the models were simpler, judgment was harder to hide. An investor had to decide whether a company's weakness was temporary or structural. He had to determine whether the seller knew something the buyer did not. He had to understand whether management could operate without the founder, whether customers were loyal to the company or to one individual, and whether cost reductions would remove waste or destroy capability. The best opportunities were often created by neglect. A business inside a large corporation might receive little attention because it was too small to matter. A family company might possess loyal customers but lack modern systems. A division could be strategically valuable to the wrong owner and transformational to the right one. The early buyout opportunity was therefore not simply to buy cheaply. It was to care more. That principle remains powerful. Ownership concentrates attention. A public company may have dozens of business units and competing stakeholder demands. A sponsor-backed company usually has a smaller board, a clearer plan, and a limited period in which to act. Decisions can be faster because responsibility is visible, but concentrated ownership also concentrates the possibility of harm. When a sponsor is wrong, there are fewer excuses. Debt may reduce flexibility. A narrow board may become an echo chamber. A management team may pursue an aggressive plan because the financial structure leaves no room for modest performance. The history of private equity is therefore a history of two competing instincts. One sees the company as an enterprise. customers, employees, processes, assets, reputation, and potential. The other sees the company primarily as a capital structure: purchase price, leverage, cash extraction, and exit. Every successful investment contains both. The business must be financed, and the financing must be served by a real business. Trouble begins when one side forgets the other. The first Grandmaster lesson is not about debt or valuation. It is about responsibility. Control is not a trophy. It is an obligation to close the distance between what a company is and what it can become. The Grandmaster's mantra: buy the business you understand, not the excitement surrounding it. The owner's notebook. Before acquiring control, ask 5 questions. What is the source of the company's durable value? Which problem is caused by the current owner rather than by the market? What capability must exist on day one that cannot be built later? What happens if improvement takes twice as long as expected? Who bears the cost if the thesis fails? Chapter 2. Jerome Kohlberg and the original Buyout philosophy. Private equity history often celebrates the visible conquerors, the financiers who won auctions, raised giant funds, and placed their names on an era. Jerome Kohlberg represented a quieter tradition. He began with a belief that ownership could be transferred in a way that aligned managers, preserved functioning businesses, and created wealth without requiring theatrical hostility. The early transactions associated with Kohlberg were frequently management buyouts. Senior managers invested alongside financial sponsors and gained a direct stake in the outcome. The structure was not merely a compensation device. It was a philosophy of behavior. People act differently when the consequences of improvement belong partly to them. Kohlberg understood that incentives could turn employees from agents into owners, yet he also understood that leverage had limits. Debt could concentrate discipline, but excessive debt could convert every ordinary setback into a crisis. This tension would eventually define the industry. The method he helped develop could be used with restraint or push toward aggression. It could support succession in a healthy company or finance a competitive takeover at a price justified only by heroic assumptions. Kohlberg's importance lies in the original balance. The early model joined 4 elements: a business with understandable cash flow, managers capable of operating it, meaningful equity participation, and debt size to the company's capacity rather than the buyer's ambition. None of those elements was revolutionary alone. Together, they created a repeatable form of ownership. The model also changed the psychology of management. There is dignity in that choice. The industry often treats growth as a universal obligation. Raise a larger fund, complete larger transactions, add strategies, enter new geographies. But scale is not automatically progress. A firm must decide which opportunities strengthen its identity and which merely enlarge it. Kohlberg's legacy is therefore more than the technical architecture of the leveraged buyout. It is the idea that finance should serve a comprehensible ownership plan. Debt is not the strategy. Alignment is not a slogan. The business must remain capable of living after the financiers have left. The Grandmaster's mantra. Leverage should support the plan, never become the plan. Life lesson. The world often rewards people who expand what they created. Wisdom sometimes requires protecting the original purpose from expansion itself. Chapter 3. The Partnership That Changed Wall Street. When Henry Kravis and George Roberts joined Jerome Kohlberg in building what became Kohlberg Kravis Roberts, they formed one of the most consequential partnerships in modern finance. Their advantages were complementary. Kohlberg brought the early buyout method and a disciplined preference for manager-aligned transactions. Kravis possessed intensity, confidence, and a gift for relationships. Roberts combined analytical discipline with a capacity to organize people and capital. The partnership could identify opportunities, persuade managers, secure financing, and execute with speed. A private equity firm is often described as a collection of funds. In its early years, however, it is closer to a collection of reputations. Sellers must believe the buyer will close. Lenders must believe the sponsor will behave rationally. Managers must believe the investor can improve the business without humiliating the people who built it. Limited partners must believe the team will protect their capital when no one is watching. KKR accumulated that trust deal by deal. The firm also benefited from a changing corporate landscape. Conglomerates had assembled portfolios that were difficult to manage. Public markets did not always reward complexity. Executives wanted ownership. Banks were increasingly willing to finance acquisitions. Tax rules and capital market innovation made leveraged transactions more feasible. KKR did not invent each condition. Its genius was recognizing that the conditions formed a system. The firm's early growth demonstrates one of the central disciplines of private equity, pattern recognition. The first successful deal may be insight. The 10th requires a process. A firm must learn which characteristics repeat across industries and which are unique to a single company. The danger is that pattern recognition can become pattern imposition. Once a playbook produces success, investors begin to see every company through it. They assume costs can be reduced, managers can be replaced, acquisitions can be added, and multiples can expand. The playbook becomes a substitute for curiosity. KKR's history contains both sides. It pioneered a repeatable ownership model and later had to evolve beyond the image of the 1980s leveraged buyout. The institution expanded into credit, infrastructure, real estate, growth, insurance-related capital, and capital markets. It also developed programs designed to broaden employee ownership at portfolio companies. That evolution matters because institutions are judged not only by what made them famous, but by whether they can outgrow the limitations of their fame. The founders' partnership also teaches a harder lesson. Complementary strengths can create extraordinary performance, but success increases the importance of unresolved differences. When a firm is small, disagreement can remain personal. When it grows, disagreement becomes organizational architecture. Who has authority? What types of deals define the firm? How much risk is acceptable? Is the objective to practice a craft or build an empire? Partnership agreements can allocate economics and voting rights. They cannot create shared purpose. The KKR story is compelling because it is not simply about three men making deals. It is about a method becoming an institution, and about an institution learning to survive the mythology of its own creation. The firm that helped popularize the modern leveraged buyout eventually had to prove that it was more than a leveraged buyout firm. That is the challenge every founder faces. The skill that earns the first reputation can become the category that confines the future. The Grand Master's mantra: build a process strong enough to repeat success and a culture wise enough to question the process. The Owner's Notebook. A partnership is durable when it answers 4 questions before a crisis. What do we refuse to do, even when the economics are attractive? Who decides when conviction is divided? How will the firm evolve without abandoning its identity? What happens when the founders no longer agree? Chapter 4. The Deal That Made Private Equity Famous. The battle for RJR Nabisco became a symbol because it transformed a financial method into public theater. RJR Nabisco was a vast consumer products company with tobacco cash flows, famous food brands, valuable assets, and a management team considering a buyout. Once the possibility became public, the transaction drew competing bidders, aggressive financing, advisors, leaks, and escalating expectations. KKR ultimately prevailed with an approximately $25 billion offer, a record at the time. The deal demonstrated the power of leveraged finance. It also demonstrated the danger of auction psychology. An auction changes the investor's emotional environment. At the beginning, the buyer asks whether the company is attractive at a certain price. As competition intensifies, the question quietly changes: what must we do to win? That shift is dangerous because winning is immediate and visible. Investment performance is delayed and complex. The human mind overvalues the immediate victory. A disciplined bidder must therefore define the walkaway price before the desire to win becomes part of the thesis. The numbers should reflect operating reality, financing risk, and a reasonable range of outcomes. It should not be adjusted merely because a rival appears confident. RJR Nabisco was not a simple failure. The company contained substantial value, and the transaction influenced corporate strategy, capital markets, governance, and the public understanding of private equity. Yet the purchase price and financing burden made the investment far more difficult than the triumphant closing suggested. This is one of the enduring lessons of private equity. A good company can be a bad investment at the wrong price. The reverse is also true. A troubled company can become an excellent investment when the price reflects the difficulty and the owner possesses a credible repair plan. The RJR battle also reshaped reputation. Private equity was no longer a quiet partner in management buyouts. It became associated with corporate raids, debt, layoffs, and immense personal wealth. The industry had entered public consciousness, and the public image would affect regulation, employee trust, political scrutiny, and the ability of future firms to claim the role of patient owner. Reputation is not separate from investment performance. It influences which founders will sell, which executives will join, which regulators will cooperate, and which employees will believe the new owner's promises. The transaction therefore created two inheritances. The first was technical, proof that enormous companies could be acquired using a combination of sponsor equity, bank financing, and high-yield debt. The second was cultural, the idea that the buyout itself was the achievement. Grandmasters know that the closing dinner is not the finish line. It is the moment responsibility begins. The most dangerous sentence in an investment committee is not, "We may lose." It is, "We cannot let them have it." Once a buyer defines the opportunity through the rival's desire, independent judgment has already begun to erode. The RJR story endures because it dramatizes a universal temptation. People want to win. Investors must want to be right more than they want to win. The Grandmaster's mantra: never confuse winning the auction with winning the investment. Life lesson: competition can clarify value, but it can also replace value with pride. Decide what something is worth before someone else makes you afraid to lose it. Chapter 5. Leverage: servant weapon or executioner. Leverage is the most misunderstood tool in private equity. To supporters, debt creates discipline, reduces the amount of equity required, and improves returns. To critics, it transfers risk to the company, enriches the sponsor, and makes employees or creditors vulnerable when conditions worsen. Both views describe real outcomes. The difference lies in the amount of debt, the quality of the business, the price paid, the terms of the financing, and the owner's behavior. Consider a simplified acquisition. An investor buys a company for $500 million, using $200 million of equity and $300 million of debt. 5 years later, the company is sold for $700 million after repaying the debt. Ignoring fees, interest, taxes, and interim cash flows, the investor receives $400 million on $200 million invested, a 2x multiple. If the same company had been purchased entirely with equity and sold for $700 million, the gain would be $200 million on $500 million invested, a 1.4x multiple. Debt magnifies the equity outcome because the buyer controls the same asset with less equity. But magnification has no moral preference. If the company is sold for $350 million, the debt still has priority. The equity may be largely or completely lost. If earnings decline, interest expense remains. If refinancing markets close, a business that is operationally sound may face a liquidity crisis. The correct question is not whether leverage is good. It is whether the company can survive an ordinary amount of bad luck. A resilient capital structure accounts for volatility, cyclicality, customer concentration, capital expenditure, working capital needs, litigation, regulation, and the possibility that the exit window will not open on schedule. It also accounts for management attention. A team consumed by weekly liquidity may not have the capacity to innovate. Private equity firms often describe debt as a discipline. This can be true. A company with obligations must prioritize cash, control spending, and confront underperformance. Yet discipline imposed externally can become fear. Managers may delay hiring, maintenance, product development, or customer investment because the immediate covenant matters more than the long-term franchise. The best investors treat leverage as one layer of a broader design. They match amortization to cash generation. They maintain liquidity. They build downside cases that are emotionally credible rather than mathematically convenient. They ask what happens if the company misses the plan by 20%, not whether the spreadsheet can withstand a cosmetic adjustment. They also recognize that different businesses deserve different capital structures. A software company with high recurring revenue and low capital expenditure may carry debt differently from a hospital, retailer, manufacturer, or game publisher. Stability in historical data is not the same as durability in the future. The Grandmaster's discipline is to leave room for uncertainty. The aggressive investor asks, how much debt can lenders provide? The owner asks, how much debt allows this company to remain capable? That difference is small in language and enormous in consequence. The Grandmaster's mantra: a capital structure is sound only if the business can remain rational when the forecast is wrong. The owner's notebook. Stress the debt against 4 events. Revenue falls while costs decline slowly. A major customer leaves. Refinancing is unavailable for 2 years. The company must invest during the downturn rather than cut. A structure that survives only by stopping the company from behaving like a healthy company is not truly resilient. Part 2. The Institution Builders. Chapter 6. Stephen Schwarzman and the Architecture of Blackstone. Blackstone began in 1985 with two founders, Stephen A. Schwarzman and Peter G. Peterson, and a name assembled from pieces of their own. The firm did not begin as the giant it later became. It began with ambition, relationships, advisory work, and the need to persuade institutions that a new organization deserved trust. The visible story of Blackstone is scale. By mid-2026, the firm reported more than $1.3 trillion in assets under management across private equity, real estate, credit, infrastructure, life sciences, growth, secondaries, and other strategies. But scale is the result. The more useful question is how a new firm builds the right to become large. Schwartzman's central talent was institutional architecture. He understood that an investment firm must produce more than returns. It must produce confidence. Confidence among limited partners, lenders, employees, sellers, public officials, and executives considering whether to entrust their careers to the platform. Confidence is built through repeated behavior. Close when you say you will close. Tell investors bad news before they discover it elsewhere. Protect the franchise when a single transaction offers tempting economics but unacceptable reputational risk. Recruit people whose skills exceed the founders in areas the firm intends to enter. Blackstone also learned to expand by building adjacent capabilities rather than treating diversification as a collection of unrelated products. Real estate offered a vast field in which the firm could apply distressed thinking, operating partnerships, and large-scale capital. Credit expanded the firm's ability to understand and finance capital structures. Secondaries created another way to deploy information, relationships, and underwriting discipline. Infrastructure and insurance-related strategies extended the duration and sources of capital. The danger of diversification is loss of identity. When a firm becomes a financial supermarket, each business can begin operating under a different culture. Risk systems may fragment. Incentives may reward asset gathering more than performance. Clients may no longer understand what the institution does exceptionally well. Blackstone's answer has been to make scale itself part of the value proposition. The firm argues that its information, networks, portfolio breadth, and ability to assemble capital create pattern recognition unavailable to smaller competitors. This advantage is real, but it must be constantly earned. Information becomes useful only when the organization can move it across internal boundaries without creating bureaucracy. Schwartzman's leadership also demonstrates the power of narrative. Large capital commitments require investors to believe not only in a fund, but in a future. The best fundraisers explain why the opportunity set exists, why their institution is positioned to capture it, and why the organization will remain stable for the life of the capital. Narrative becomes dangerous when it outruns evidence. An institution that becomes skilled at describing its greatness may begin to believe that access itself is an investment edge. Grandmasters remain suspicious of their own reputation. They understand that a powerful brand improves deal flow, but can also make expensive opportunities look proprietary. Blackstone's evolution from advisory boutique to global alternative manager reveals three forms of leverage beyond debt. The first is reputational leverage. Each successful engagement makes the next conversation easier. The second is intellectual leverage. A lesson learned in one portfolio or asset class can improve judgment elsewhere. The third is organizational leverage. A platform can create capabilities that no single fund could afford alone. These forms of leverage compound without appearing on a balance sheet. They also explain why the leading firms can become difficult to displace. Still, institutional greatness cannot be measured by permanence alone. A firm must answer whether its growth improved the quality of ownership. Did greater scale provide portfolio companies with more resources, better data, stronger executives, and patient capital? Or did it primarily produce more fees and a constant need to deploy? The answer may differ by transaction. That is precisely why scale cannot substitute for case-by-case judgment. Schwartzman's enduring lesson is not simply to think big. It is to build systems capable of carrying ambition without collapsing beneath it. The Grand Master's Mantra. Scale is earned through trust before it is measured in assets. Life lesson. Ambition becomes durable only when the institution grows faster than the ego of its founder. Chapter 7. From Financial Engineering to Industrial Ownership. KKR entered public imagination through leveraged buyouts. Its long-term survival required it to become something broader. The early KKR model was associated with concentrated control, management incentives, and the use of debt to acquire large companies. Over time, markets changed. Banks became more regulated, public scrutiny increased, institutional investors demanded new strategies, competition drove prices higher. The easy caricature of the buyout firm no longer explained the organization. KKR responded by building a global investment platform. It expanded into credit, infrastructure, real estate, growth, insurance-related capital, and capital markets. The transformation was not merely diversification. It reflected an important insight. Ownership is strongest when the investor understands the whole capital structure and can provide more than one form of capital. A company may need equity today, refinancing tomorrow, acquisition financing later, and access to a capital market at exit. A firm capable of operating across those needs can become a strategic partner rather than a temporary owner. But breadth creates conflicts. A credit fund may lend to a company another team hopes to acquire. A capital markets business may earn fees arranging financing for a portfolio company. Insurance capital may prefer long-duration assets, while buyout investors seek a defined exit. Governance must be strong enough to preserve trust among clients whose interests are not identical. KKR's modern identity also includes a renewed emphasis on ownership culture. The firm has promoted broad-based employee ownership programs in certain portfolio companies, arguing that frontline workers should participate in the value they help create. The idea returns private equity to one of its original strengths: alignment. Equity grants alone do not create ownership behavior. Employees must understand the plan, receive financial education, and believe management will share information honestly. A token stake attached to unrealistic targets can feel manipulative. A meaningful program, combined with operational investment and credible leadership, can improve retention, engagement, and the legitimacy of the ownership model. This matters because private equity has long concentrated upside among sponsors and senior executives. Broadening participation does not erase every criticism, but it changes the social contract. It tells employees that value creation is not something done to them or around them. KKR's evolution contains another lesson. A firm must outlive the transaction that defined it. RJR Nabisco made KKR famous, but fame can trap an institution inside an old image. The firm had to demonstrate that it could create value through operations, sector expertise, infrastructure, credit, and patient partnerships, not only through aggressive leverage. Institutional reinvention requires continuity and rejection. The firm must preserve principles that still work while abandoning habits tied to a different market. That is difficult because old habits are often embedded in compensation, promotion, and status. KKR's history suggests that the highest form of private equity is not financial engineering or operational engineering alone. It is ownership engineering, the deliberate design of incentives, governance, capital, talent, and time. The company under ownership must know what matters, who decides, how progress is measured, and what happens when reality diverges from plan. The sponsor must know when to intervene and when to let operators operate. Too little involvement produces passive ownership. Too much produces confusion and weak management. The Grand Master creates a system in which accountability is concentrated without becoming suffocating. The Grand Master's mantra: ownership must become a system, not an event. The Owner's Notebook. A sponsor should be able to describe its contribution without mentioning the purchase price, leverage, or exit multiple. If the explanation becomes vague, the value creation plan may be financial rather than operational. Chapter 8. Apollo and the Profit Hidden Inside Complexity. Apollo Global Management was born from disruption. Its founders emerged from the aftermath of Drexel Burnham Lambert, an institution central to the high-yield market and the buyout boom of the 1980s. The environment taught a severe lesson. When capital structures break, value does not disappear evenly. Complexity creates fear. Fear creates forced sellers. Forced sellers can create opportunity for investors capable of distinguishing temporary liquidity from permanent loss. Apollo built a reputation around value-oriented and contrarian investing, particularly in credit and distressed situations. The firm was willing to examine assets that conventional buyers found difficult: complicated securities, over-leveraged companies, cyclical industries, and transactions requiring control of both debt and equity. The edge was not simply a tolerance for discomfort. Plenty of investors enjoy calling themselves contrarian. The real edge was analytical. Understand the documents, priorities, collateral, covenants, legal rights, and possible restructuring outcomes better than the market. In distressed investing, the purchase price is only the beginning. The investor must understand where value sits in the capital structure and how that value can migrate during a restructuring. A senior claim may be protected by collateral, but impaired by weak documentation. A junior security may appear worthless, but gain negotiating power if its consent is required. Control may be acquired not through a traditional buyout, but through debt ownership and a reorganization. This requires patience and emotional independence. Distressed assets are surrounded by bad news. Management may be defensive. Employees may be frightened. Lenders may disagree. Public markets may assume the worst. An investor must decide whether the disorder is the source of the discount or evidence that the business itself is unsalvageable. Apollo's later growth into retirement services and insurance-related capital changed the scale and character of the organization. By March 31, 2026, Apollo reported approximately $1.03 trillion in assets under management. The combination of asset management and retirement services liabilities created a vast demand for yield-generating assets. This model offers powerful advantages. Long-duration capital can support investments that do not fit short fund lives. A large origination platform can source private credit. Insurance liabilities can be matched with assets designed to produce stable returns. It also demands exceptional governance. Insurance capital represents promises to policyholders. The search for yield must remain subordinate to liquidity, duration, credit quality, and regulatory requirements. Complexity that creates opportunity for the manager can create opacity for outsiders. Apollo therefore represents the modern convergence of private equity, credit, insurance, and permanent capital. The organization is not easily described by the traditional image of a buyout fund. It is a capital ecosystem. The investor's lesson is that complexity can be a moat, but only when it's understood at the level of consequence. A complicated model is not evidence of sophisticated thinking. It may be evidence that the thinker has not identified the decisive variable. The best complex investors can explain the risk simply. They know which contract matters, which cash flow is durable, which party has negotiating power, and what event would invalidate the thesis. Apollo's method also carries a moral responsibility. Distressed situations involve real institutions and real people. Restructuring may be necessary, but necessity should not become an excuse for indifference. The most capable investor can still choose whether to extract every technical advantage or preserve value for the broader enterprise. Sophistication is not only the ability to win a complex negotiation, it is the ability to understand what the victory changes. The Grand Master's mantra: complexity is valuable only when you understand it better than everyone else. Life lesson: do not seek confusion for its own sake. Seek situations where confusion causes others to misprice something you can explain clearly. Chapter 9. Carlyle and the Power of the Global Network. Carlyle was founded in Washington, Dopo Cristo, in 1987, a location that helped shape its early identity. While many buyout firms projected a Wall Street image, Carlyle became known for relationships, sector knowledge, public policy awareness, and a global network. The firm's founders, David Rubenstein, William Conway Jr., and Daniel Daniello, combined different strengths. Rubenstein became a celebrated fundraiser and institutional ambassador. Conway brought investment judgment and discipline. Daniello helped build the organizational and financial foundation. Carlyle's growth demonstrated that access is a form of capital. Relationships can reveal transactions before they become auctions. Local knowledge can help a global investor understand regulation, ownership culture, and political risk. A respected network can attract executives and strategic partners. But access is not the same as edge. A firm may enter the room because of relationships and still make a poor investment. The danger is that proximity to influence creates confidence unsupported by business fundamentals. Carlyle expanded across geographies and sectors, including aerospace, defense, healthcare, technology, consumer, industrials, credit, and secondaries. By March 31, 2026, it reported approximately $475 billion in assets under management. Global expansion requires a delicate balance. Local teams need authority because markets differ. Headquarters needs oversight because capital and reputation are shared. If control is too centralized, the firm misunderstands local reality. If it is too decentralized, standards fragment and the brand becomes a collection of unrelated offices. The best global firms create a common investment language. They define how risk is discussed, how conflicts are handled, how assumptions are challenged, and how portfolio problems are escalated. Local insight enters the process without escaping institutional discipline. Carlyle also illustrates the importance of fundraising as a professional craft. Investors do not commit 10-year capital only because of a presentation. They commit because they believe the firm will remain capable, honest, and aligned through cycles that cannot be predicted. The fundraiser carries two obligations. The first is to communicate the opportunity. The second is to prevent enthusiasm from overstating certainty. Great fundraising creates informed conviction. Poor fundraising creates expectations the investment team cannot responsibly satisfy. Carlyle's history has included leadership transitions, strategic shifts, and periods of uneven performance. That is not unusual for a large institution. What matters is how the firm responds when the original model no longer produces the same results. The network must evolve from a founder asset into an organizational asset. Relationships held only by senior individuals can disappear when they retire. A durable institution records knowledge, develops successors, and gives younger professionals the credibility to build new networks. The life lesson is broader than finance. Relationships open doors, but what happens after the door opens determines whether the relationship becomes trust or merely access. The Grand Master's mantra: access can create opportunity. Only performance preserves access. The Owner's Notebook. When evaluating a relationship-driven firm, ask, are opportunities distributed institutionally or controlled by a few people? Can the next generation build trust without borrowing the founders' names? Does political or sector access improve underwriting or merely increase confidence? Are local teams empowered and accountable? The best operating partner does not arrive with a universal answer. She asks which capabilities the company lacks, which strengths must be protected, and where management wants help. She knows when to challenge and when to listen. Bain's consulting heritage also emphasizes the value of hypothesis-driven work. Instead of collecting every possible fact, the investor identifies the questions most likely to determine the outcome. Is customer retention truly durable? Can pricing increase without weakening volume? Does the business possess scale advantages or merely size? Can a regional model travel? This approach improves speed, but it can create confirmation bias if the initial hypothesis becomes a commitment. Strong investment committees reward disconfirming evidence. They do not ask only whether the thesis can work. They ask what would prove it false. Bain Capital's broad platform has included buyouts, venture capital, credit, public equity, real estate, and other strategies. The expansion reflects a general industry trend. Firms seek to serve investors across more parts of the portfolio. Yet the consulting lesson remains most powerful at the company level. Strategy must become behavior. A value creation plan is meaningless until someone owns each initiative. Milestones are defined, resources are allocated, and trade-offs are acknowledged. A beautiful slide does not reduce inventory. A framework does not retain a customer. An owner must convert analysis into operating rhythm. The Grand Master's mantra: a strategy is not real until an operator can execute it. Life lesson: intelligence is the ability to form a good answer. Responsibility is the willingness to remain present while the answer meets reality. Chapter 11. TPG and the Courage to Enter Difficult Rooms. TPG was founded as Texas Pacific Group by David Bonderman, James Coulter, and William Price. The firm became known for pursuing complicated, contrarian, and often international opportunities. One of its defining early transactions was the rescue of Continental Airlines from bankruptcy. The deal required more than buying a cheap security. It required a view on labor, roots, management, customer confidence, and whether a failed organization could become functional under new leadership. This kind of investing depends on courage, but courage is an imprecise word. In markets, it is easy to confuse courage with the desire to appear bold. Real investment courage has three components. First, the investor understands why others are afraid. If the fear is irrational or temporary, it may create opportunity. If the fear reflects permanent impairment, ignoring it is not courage. Second, the investor possesses a specific advantage: information, operating capability, financing, relationships, or time. Third, the investor can survive being early. A contrarian thesis often looks wrong before it looks right. The capital structure must allow patience. TPG expanded into growth equity, impact, healthcare, technology, consumer, and other strategies. Its history includes successes and painful losses, as any long-lived contrarian institution's history will. The difficult room philosophy is useful because attractive opportunities rarely arrive without discomfort. Corporate carve-outs may lack standalone systems. Emerging market deals may face currency and political risk. Turnarounds may require replacing leadership while preserving customer trust. Growth investments may involve companies whose potential is evident, but whose economics remain immature. The investor's job is not to eliminate uncertainty. It is to identify which uncertainty is compensated. TPG's experience also demonstrates that a strong thesis can be overwhelmed by a weak structure. An investor may be correct about the long-term quality of a business and still lose because the company runs out of liquidity before the thesis matures. Time is an asset only when it has been financed. The firm later developed large impact investing platforms, reflecting an effort to link commercial opportunity with measurable social and environmental outcomes. Impact investing raises the standard of proof. The manager must show that returns are real and that the claimed impact is not merely branding. This requires clear measurement, additionality, and honesty about trade-offs. A company can produce a useful product and still treat employees poorly. A green investment can reduce emissions and still depend on subsidies. Impact is most credible when it is integrated into the business model, rather than attached to a marketing narrative. The Grandmaster lesson from TPG is that difficult rooms reward preparation. The best contrarian is not the loudest person rejecting consensus. It is the quiet investor who understands why consensus formed, where it is wrong, and what must happen before the market changes its mind. The Grandmaster's mantra: courage without discipline is gambling. Discipline without courage is stagnation. The owner's notebook. Before entering a distressed or unpopular situation, write down what the market believes, why that belief exists, which part is correct, which part is mispriced, and how long the company can survive before the mispricing closes. Chapter 12. CVC, EQT, and Advent. Building global firms locally. Private equity's largest institutions often speak in global language, but deals are executed locally. A company is governed by specific laws, serves particular customers, employs people shaped by local culture, and operates inside political and social expectations that cannot be understood from a distant headquarters. CVC Capital Partners, EQT, and Advent International built global reach through different histories, but each illustrates the value of local presence. CVC developed a broad network across Europe, the Americas, and Asia. Its Europe Americas Fund 9 closed at €26 billion in 2023 and later reflected additional general partner commitments. The fund was described by the firm as the largest private equity fund raised at the time. By 2026, CVC reported a global network of offices and strategies spanning private equity, secondaries, credit, and infrastructure. EQT grew from Nordic roots influenced by the Wallenberg tradition of long-term industrial ownership. It developed an approach that combined sector expertise, local networks, and operational development. As of March 31, 2026, EQT reported €269 billion in total assets under management across private capital and real assets. Advent built a global buyout organization with a long history of investing across regions and sectors. Its strength has often been the ability to connect local teams with a common investment process. The operating challenge is similar for all three. How can a firm be global without becoming generic? A centralized firm may impose a consistent process but miss local nuance. A decentralized firm may understand each market but fail to share knowledge. The Grandmaster solution is not complete centralization or complete autonomy. It is a federation built around common principles. The principles should answer how value is assessed, how risk is escalated, how investment committees work, and how portfolio companies are supported. Local teams should retain enough authority to interpret culture, regulation, and management quality. Global firms also benefit from cross-border pattern recognition. A payments model observed in one country may appear later in another. A healthcare service can expand through similar demographic trends. A software company can use the firm's international network to enter new markets. Yet copying is dangerous. A playbook that succeeds in the United States may fail in Germany because labor practices differ. A consumer concept may not travel because local habits are stronger than financial projections. A regulated industry may reward a local incumbent's relationships more than a global sponsor's capital. Global ownership therefore requires humility. The sponsor must know what can be standardized and what must remain local. These firms also illustrate the fundraising advantage of a broad investor base. Large funds require commitments from pensions, sovereign wealth funds, insurers, endowments, and family offices across regions. Diversified capital can stabilize fundraising, but it creates a complex set of expectations. Different investors care about liquidity, reporting, sustainability, co-investment, and governance in different ways. The institution must be capable of serving those needs without allowing fundraising preferences to distort investment decisions. A fund should not become a product designed backward from investor demand. Capital should follow a coherent opportunity set. The Grand Master's mantra. Global scale is built locally. One relationship and one operating truth at a time. Life lesson. What travels well is principle. What must be relearned is context. Part 3. The specialists who changed the game. Chapter 13. Vista Equity Partners and the Software Operating System. Vista Equity Partners built its reputation by treating enterprise software as a distinct operating universe. The industry was attractive for reasons that became familiar: recurring revenue, high gross margins, mission-critical products, low customer churn, and opportunities to improve sales efficiency, pricing, product development, and acquisitions. But recognizing an attractive sector was not enough. Vista sought to create a repeatable system for operating inside it. Specialization changes the quality of questions. A generalist may ask whether revenue is recurring. A software specialist asks how recurring it truly is. Are renewals contractual or habitual? Is retention measured gross or net? How much growth comes from price, seat expansion, new modules, or acquisitions? Does the product sit inside a customer's workflow, or is it merely tolerated because replacement is inconvenient? A specialist also builds a deeper talent network. Executives, advisors, recruiters, lenders, and operating professionals begin to understand the firm's expectations. Due diligence becomes faster because the investor knows which metrics deserve skepticism. Vista's approach became associated with standardized operating practices, often described through the Vista Best Practices framework. The ambition was to convert lessons across portfolio companies into a common system, measure sales productivity, strengthen recurring revenue, professionalize management, optimize research and development, and improve customer economics. A playbook can create extraordinary leverage. Instead of beginning every investment from zero, the owner starts with accumulated knowledge. A pricing initiative tested in one company can inform another. A recruitment process can be repeated. A software acquisition can be integrated using a known sequence. The risk is that repeatability becomes rigidity. Every company has a history, product culture, customer base, and technical architecture. A standardized process can improve weak execution, but it can also flatten the qualities that made the company distinctive. The Grand Master Specialist knows the difference between a principle and a prescription. The principle may be that every company needs rigorous customer retention data. The prescription for improving retention will differ. The principle may be that sales compensation should reward durable value. The right plan depends on product complexity, channel structure, and customer acquisition cost. Vista's history also demonstrates the reputational vulnerability of founder-centric firms. When a leader becomes strongly identified with an institution, personal events can create organizational risk, even when the investment process is broader than one person. Succession, governance, and distributed authority are not administrative details. They are investment infrastructure. The software model itself has evolved. Rising interest rates changed the value of distant cash flows. Artificial intelligence created both opportunity and threat. Some software products can incorporate AI and deepen customer value. Others may be displaced by new interfaces, lower-cost competitors, or customers building internally. A recurring subscription is not automatically a durable moat. Customers renew because switching is costly, because the product is excellent, or because no credible alternative exists. Each source of retention carries a different risk. Vista's most transferable lesson is that specialization compresses the learning curve. But specialization remains powerful only when the specialist continues learning. The investor who knows a sector well may see more than the generalist. The investor who believes she already knows the answer may see less. The Grand Master's mantra. Specialization turns pattern recognition into speed, but curiosity keeps speed from becoming error. The Owner's Notebook. For recurring revenue businesses, separate 5 ideas that are often confused. Contracted revenue, historically repeated revenue, economically necessary revenue, revenue protected by switching cost, revenue protected by customer delight. The fifth is the most valuable and the hardest to model. Chapter 14. Thoma Bravo and the Discipline of Software Buyouts. Thoma Bravo became one of the defining software investors of the modern buyout era. Its rise reflected a concentrated belief software companies could be acquired, improved through disciplined operations, and combined into stronger platforms. The firm's heritage stretches through predecessor organizations and the career of Carl Thoma, but its modern identity is closely associated with Orlando Bravo and a strategy focused on enterprise software and technology-enabled businesses. Software buyouts attracted capital because the economics appeared unusually favorable. Once a product is built, incremental distribution can be highly profitable. Subscription models improve visibility. Customers often face meaningful switching costs. Data, integrations, and workflow dependence can deepen the relationship, yet software can hide weakness behind growth. A company may report recurring revenue while spending heavily to replace customers who leave. It may describe a broad market while relying on a narrow product. It may possess technical debt that slows development. Its product may be embedded but disliked, leaving it vulnerable when a credible alternative appears. Thoma Bravo's approach emphasized operational measurement and acquisition strategy. A platform company could acquire complementary products, expand distribution, and strengthen its position. Cost discipline could improve margins. A focused owner could make decisions more quickly than a public company balancing quarterly expectations. The buy and build model is powerful when each acquisition improves the system. It becomes dangerous when acquisitions are used to conceal weak organic growth. Consolidated revenue can rise while customer satisfaction falls. Expense synergies can be realized while product complexity increases. A grandmaster therefore asks whether the platform is becoming more valuable to customers or merely larger to investors. Thoma Bravo's fundraising success also illustrates the market's willingness to reward a clear identity. Limited partners understand what the firm intends to do. Sellers recognize the brand. Executives know the operating expectations. Clarity reduces friction across the investment process. By late 2025, Thoma Bravo described itself as a software-focused investment firm with more than $180 billion in assets under management. Its senior business leadership included Jennifer James, serving as managing director, chief operating officer, and head of investor relations and marketing. The presence of senior operating, fundraising, legal, finance, and human capital leaders highlights an often overlooked truth. Investment firms are businesses. Exceptional deal professionals alone do not build durable platforms. The organization must serve investors, manage risk, recruit talent, protect information, and coordinate decisions across funds. The software sector now faces a new question. Artificial intelligence can increase productivity and expand product capabilities, but it may also reduce the value of established code. Products once protected by development cost can be replicated more quickly. User interfaces may shift from menus and dashboards to conversational agents. Pricing based on seats may weaken if automation reduces the number of human users. The specialist's advantage is not the belief that software will remain attractive. It is the ability to distinguish software that AI strengthens from software that AI commoditizes. The enduring lesson is disciplined focus. Thoma Bravo demonstrates how a firm can create advantage by saying no to most of the market. But focus must remain an active choice, not an inherited identity. The Grand Master's Mantra. A repeatable playbook creates value only while it remains responsive to the game being played. Life lesson. Mastery is not repeating yesterday's answer with greater confidence. It is preserving first principles while the environment changes. The Grand Master's Mantra. Conviction should reduce activity, not reduce scrutiny. The Owner's Notebook. Before concentrating capital, complete this sentence. We are willing to own less because we understand more about. If the blank is filled with general optimism rather than a specific insight, the concentration is not earned. Chapter 16. Clearlake and the Marriage of Credit and Control. Clearlake Capital developed an investment approach that combined private equity with credit and special situations thinking. The firm became known for its OPS framework, operations, people, and strategy, and for investing in technology, industrials, and consumer businesses. The combination of credit and equity perspectives can be powerful because the same company looks different depending on where the investor sits in the capital structure. An equity investor focuses on upside, control, and enterprise growth. A credit investor focuses on downside, contractual protection, cash flow, and recovery. The strongest owner can think in both directions. This dual perspective improves entry decisions. The investor asks not only how much the equity may earn if the plan works, but what the assets and cash flows are worth if it does not. She studies covenants, maturity walls, liquidity, and refinancing requirements before the company becomes distressed. It also expands the opportunity set. A firm may enter through debt, provide rescue capital, negotiate a restructuring, or acquire control through a conventional transaction. The investor is less dependent on one market being open. But integrated strategies create complexity. A manager may hold debt in one vehicle and equity in another. Interests can diverge. The debt fund may benefit from terms that reduce equity value. Governance, disclosure, and conflict management must be strong enough to protect every client. Clearlake's operational framework reflects a broader industry evolution. The modern sponsor is expected to possess a theory of improvement. Operations examines processes, costs, technology, pricing, and execution. People examines leadership, incentives, talent, and culture. Strategy examines markets, products, positioning, and capital allocation. The order matters. A brilliant strategy cannot compensate for weak leadership. A talented team cannot overcome a structurally unattractive market without changing the business. Cost improvements cannot create lasting value if customers are leaving. The framework becomes most useful when the categories interact. A new strategy may require different people. A technology investment may change operations. An acquisition may strengthen the market position but overwhelm integration capacity. The special situations mindset also teaches respect for liquidity. Companies rarely fail because the 5-year plan was mathematically impossible. They fail because they cannot meet an obligation on a particular day. An owner must therefore map the path, not only the destination. How much cash is required each quarter? What happens if working capital moves against the business? Which facilities can be drawn? What must be refinanced and when? Private equity presentations often place the downside case in an appendix. Credit-minded investors begin there. The marriage of credit and control is most powerful when it produces humility. Equity encourages imagination. Credit imposes consequence. Together, they ask whether the upside is worth pursuing and whether the company can remain alive long enough to reach it. The Grand Master's mantra: underwrite the upside with an owner's imagination and the downside with a lender's suspicion. Life lesson. Hope asks what may happen. Responsibility asks what must still be paid if it does not. Chapter 17. Tay Associates, Great Hill, and the Mid-Market Compounding Machine. The private equity industry often directs attention toward mega funds and record transactions. Yet some of the most durable value creation occurs in the middle market, where companies are large enough to possess established economics but small enough to transform. TA Associates built a long history in growth-oriented investing, often backing profitable companies in technology, financial services, healthcare, consumer, and business services. Great Hill Partners developed a reputation in growth companies across software, digital commerce, financial technology, and related sectors. The middle market offers a different form of leverage. A $100 million company can double through a combination of organic growth, professional management, new products, and acquisitions. A $100 billion company cannot rely on the same path. Smaller businesses may have attractive niches, loyal customers, and strong founders, but lack systems, leadership depth, or international distribution. The investor's opportunity is to build the institution around the product. This may require hiring a chief financial officer, formalizing sales management, implementing customer analytics, improving cybersecurity, or creating a board. These changes are not glamorous, but they can convert founder-dependent success into a scalable company. Founder partnerships require sensitivity. The founder may have created the culture, product, and customer relationships. She may also be the greatest constraint on the next stage. The sponsor must determine whether the founder wants liquidity, growth, control, or a gradual transition. Misalignment at the beginning becomes conflict later. The best middle market investors do not treat founders as obstacles to professionalization. They identify which founder instincts are irreplaceable and which responsibilities should move to a broader team. Growth equity also changes the use of debt. Some investments rely on less leverage because the value thesis depends on expansion rather than immediate cash generation. This reduces financial risk but increases execution risk. The company must hire ahead of revenue, enter new markets, and preserve culture while becoming more complex. The mid-market compounding machine often uses acquisitions. A platform can buy smaller competitors, add capabilities, and create scale. The opportunity is attractive because fragmented industries contain many targets, but roll-ups are not automatic value creation. Each acquisition creates integration work. Different systems, cultures, pricing models, and customer promises must be reconciled. A company can become larger while becoming less coherent. A disciplined sponsor measures integration capacity before announcing the next deal. It tracks whether the first acquisition delivered the expected customer retention, cost savings, and leadership stability. It does not assume that volume will solve complexity. TA Associates and Great Hill also remind investors that consistency can matter more than visibility. A firm that repeatedly creates value in smaller transactions may produce stronger risk-adjusted outcomes than a firm known for a single spectacular deal. Private equity greatness should therefore be measured across dimensions: return, loss ratio, consistency, governance, and the condition of companies after exit. The largest opportunity is not always attached to the largest company. Sometimes it is attached to a business with one excellent product, a loyal customer base, and an owner who has reached the limit of what one person can carry. The Grand Master's Mantra. The middle market rewards investors who can turn entrepreneurial energy into institutional capability without extinguishing it. The Owner's Notebook. When evaluating a founder-led company, ask which customer relationships belong to the business and which belong to the founder. What decisions still require one person's approval? Which systems will break if revenue doubles? Does the founder want a partner, a buyer, or permission to leave? Part 4. The Deals That Became Legends. Chapter 18. Hilton. Buying before the world broke. In July 2007, Blackstone agreed to acquire Hilton Hotels Corporation in a transaction valued at approximately $26 billion. It was the kind of deal that defined the peak of the pre-crisis credit market: a famous brand, global assets, abundant financing, and confidence that travel would continue expanding. Then the world broke. The financial crisis weakened travel, reduced property values, closed financing markets, and placed severe pressure on highly leveraged investments. Hilton's acquisition became an example of timing at its worst. Blackstone wrote down the value of its investment, and outside observers questioned whether the transaction would become a monument to the excesses of 2007. The story did not end there. Hilton's later recovery became one of private equity's most celebrated outcomes. Blackstone and management refinanced debt, extended maturities, invested in the company, expanded the brand portfolio, increased the use of management and franchise contracts, and prepared Hilton for a return to public markets. Over time, the company became less dependent on owning physical hotels and more focused on managing brands, systems, loyalty, and distribution. The transformation illustrates the difference between owning assets and owning an economic system. Hotel real estate requires capital and carries cyclical exposure. A management or franchise model can grow with less capital while earning fees from a larger network. Blackstone's advantage was not the ability to predict the financial crisis. It did not. The advantage was the ability to survive it and continue making decisions after the original timing thesis had failed. Survival required capital, lender negotiation, management quality, and patience. A smaller or more fragile owner might have been forced to sell at the bottom. Blackstone's platform and relationships allowed it to remain engaged through the cycle. Published accounts have described Hilton as producing one of the largest dollar profits in private equity history, with Blackstone realizing approximately $14 billion in profit over the life of the investment. Estimates of the exact multiple and internal rate of return vary depending on methodology, timing, and treatment of proceeds. The lesson does not depend on selecting the most dramatic number. The important attribution question is what created the value. Part came from market recovery. Hotel demand improved. Public valuations recovered. Credit markets reopened. Part came from operational and strategic change. Hilton expanded its brands, increased rooms under management and franchise arrangements, strengthened systems, and improved capital efficiency. Part came from financing decisions that gave the company time, and part came from the simple refusal to convert a temporary mark into a permanent loss. Private equity often presents patience as a virtue, but waiting while a company weakens is not patience. True patience requires active ownership, improve the business, preserve liquidity, and make the company more capable while the market remains unfavorable. Hilton also teaches the danger of judging an investment too early. A deal announced at the peak can ultimately succeed. A deal purchased at a low price can ultimately fail. The path matters because the owner must remain solvent and credible long enough for the thesis to mature. The Grandmaster's question during crisis is not, how do we prove the original decision was right? It is, given the company we own today, what decision creates the most value from here? That mindset frees the owner from defending the past. The Grandmaster's mantra. A difficult entry does not require a desperate exit. Life lesson. When circumstances invalidate the original plan, loyalty should belong to reality, not to the plan. Chapter 19. HCA, Scale, Healthcare, and the Long Hold. In 2006, a consortium including KKR, Bain Capital, Merrill Lynch Global Private Equity, and members of HCA's founding Frist family agreed to acquire HCA in a transaction valued at roughly $33 billion, including debt. It was among the largest leveraged buyouts of its era. HCA was not an ordinary company. It operated hospitals and healthcare facilities inside a system shaped by regulation, reimbursement, labor, clinical quality, demographics, and public responsibility. A hospital cannot be managed like a software company or a consumer brand. Decisions about staffing, capital expenditure, and service lines have consequences measured in patient outcomes as well as financial performance. The investment thesis benefited from scale. HCA could negotiate purchasing, invest in systems, share clinical and operational practices, and use data across a broad network. The consortium also partnered with an experienced management team and a family deeply connected to the company's history. The transaction later became a major financial success for the sponsors, as HCA returned to public markets and investors realized proceeds over time. Published estimates of exact sponsor returns vary, and the complexity of dividends, offerings, ownership changes, and timing makes simple comparisons difficult. The more useful lesson concerns the interaction of ownership and management. Private equity firms often describe themselves as active owners, but in specialized industries, the sponsor must know the limits of its expertise. Financial professionals can improve capital allocation and governance. They cannot replace clinical judgment. The board's role is to create conditions in which qualified operators can make sound decisions and be held accountable. Healthcare investments also expose a recurring tension in private equity. Efficiency matters. Hospitals must manage costs, improve scheduling, reduce waste, and allocate capital carefully. Yet cost reduction can become destructive if it weakens staffing, maintenance, patient access, or quality. The distinction is not always visible in a quarterly report. A reduction in labor expense may improve margins before the resulting burnout, turnover, or service decline appears. An owner must therefore use operational measures that reflect the real mission of the enterprise. HCA's scale also demonstrates that regulated businesses require political and social legitimacy. A hospital system serves communities that cannot simply choose to stop needing healthcare. Owners must understand that control of essential services brings obligations beyond the investment agreement. This does not mean profit is improper. Profit provides capital, attracts talent, and supports investment. It means the pursuit of profit must respect the nature of the asset. The HCA deal also shows the value of a long hold when the company has durable demand and capable management. Private equity is often associated with 3 to 5 year exits, but large transformations may require more time. Partial realizations, public offerings, and continued ownership can allow the sponsor to capture value while the business continues developing. A long hold is not automatically patient capital. It may reflect market conditions or the inability to exit. The distinction lies in what the owner does during the time. Did the company invest? Did quality improve? Did management deepen? Did the balance sheet become more resilient? The Grandmaster recognizes that some companies cannot be reduced to a financial instrument. The business model must be understood through the human service it provides. The Grandmaster's mantra. In essential services, operational excellence and social responsibility are not competing ideas. They are part of the same license to operate. The Owner's Notebook. For healthcare and other essential service businesses, add non-financial measures to the investment committee dashboard. Safety, quality, employee turnover, access, regulatory findings, and customer outcomes. Chapter 20, TXU. When confidence met reality. In 2007, a consortium led by KKR and TPG agreed to acquire TXU, the Texas utility later known as Energy Future Holdings, in a transaction valued at approximately $45 billion, including assumed debt. It was one of the largest leveraged buyouts ever completed. The deal was built around a view of energy markets, particularly the expectation that power prices would remain supportive. The transaction also involved commitments related to environmental policy and the cancellation of planned coal plants, illustrating how public pressure and investment strategy can intersect. The central problem was not that the investors knew nothing. It was that the outcome depended heavily on a variable they could not control. Natural gas prices fell sharply. Because gas prices influenced wholesale electricity prices in Texas, the company's revenue and cash flow suffered. The heavy debt burden became increasingly difficult to service. Energy Future Holdings filed for bankruptcy in 2014. The case is often used as proof that leverage is dangerous. That is true but incomplete. The deeper lesson is the danger of building a capital structure around a macroeconomic forecast. An investor can understand an industry, hire experts, and construct detailed models. The model still cannot make commodity prices obey. When the purchase price and debt load require a specific external environment, the investor is not merely underwriting the company. She is underwriting the world. Every investment contains external assumptions. Interest rates, inflation, regulation, demand, and competition influence results. The discipline is to identify which assumption carries the most weight and ask whether the capital structure can survive if it is wrong. In TXU, the scale of the transaction amplified the consequences. Large deals can create the illusion that extensive diligence eliminates uncertainty. More advisors, more pages, and more sophisticated models may create precision without resilience. The transaction also shows why downside cases must be psychologically credible. Investment teams sometimes design downside scenarios that preserve the deal. Revenue declines modestly, costs adjust quickly, financing remains available, and the exit multiple contracts only slightly. The case is called downside, but it is merely a less attractive base case. A real downside case should threaten the thesis. What if the commodity price remains low for years? What if hedges expire? What if the company cannot refinance? What if regulatory conditions change while debt is still high? If the answer is that the equity is lost, the committee must decide whether the probability and expected return justify that risk. It should not hide the result. TXU is also a lesson in the difference between a company and a capital structure. Utilities can possess essential assets and still produce poor equity outcomes if the financing is excessive. A valuable enterprise does not guarantee valuable common equity. The Grand Master does not seek to eliminate every macro risk. That is impossible. She sizes the investment and debt so that an unfavorable world does not immediately destroy the ability to respond. The most painful investment errors often begin with a sentence that sounds reasonable. This variable has never remained at that level for long. Markets do not respect historical inconvenience. The Grand Master's mantra: a brilliant capital structure cannot rescue a broken central assumption. Life lesson: do not build a life, company, or investment that requires the world to behave exactly as expected. Chapter 21. Atlantia: Infrastructure, Permanence, and Political Risk. Infrastructure attracts private capital because it can offer long-lived assets, essential services, contractual or regulated cash flows, and protection from certain forms of economic volatility. Roads, airports, pipelines, data networks, and utilities are woven into daily life. That attraction carries a special responsibility. Infrastructure owners do not merely sell optional products. They control systems on which communities depend. In 2022, a transaction involving the Benetton family's investment vehicle, Edizione, and Blackstone, valued Atlantia at approximately 54 billion euros, including debt, with equity value commonly reported near 19 billion euros. The company, later renamed Mundys, held interests in airports, toll roads, and mobility infrastructure. The transaction followed a period of profound controversy after the 2018 collapse of the Morandi Bridge in Genoa, which killed 43 people. Atlantia's motorway subsidiary faced intense scrutiny, political conflict, and questions about maintenance, governance, and public accountability. The tragedy makes the investment impossible to discuss only through valuation. Infrastructure risk includes engineering, maintenance, safety culture, regulation, concession agreements, and public trust. A failure can destroy value, but the financial loss is secondary to the human consequence. Private ownership of infrastructure can bring capital, operational expertise, and long-term planning. It can also create tension when cost reduction or distributions appear to compete with maintenance and resilience. The owner must therefore define the economic model around stewardship. Capital expenditure should not be treated merely as a deduction from free cash flow. In infrastructure, maintenance is part of the product. Political risk is equally important. Concessions and regulated returns depend on relationships with governments and communities. An investor may possess legal rights and still lose the social legitimacy required to exercise them. Contracts matter, but public anger can change the negotiating environment. The Atlantia case also demonstrates the role of family capital and long-duration ownership. Ediciones' involvement reflected strategic and historical interests that differ from a conventional finite-life buyout fund. Blackstone brought large-scale infrastructure and capital expertise. Different owners may accept different holding periods and return profiles. A family or permanent capital vehicle can think across generations. A fund must usually return capital within a defined life. Neither is inherently superior, but the asset should be matched to the owner's time horizon. Infrastructure is particularly vulnerable to mismatch. A road, airport, or network may require decades of investment. If the ownership model depends on a rapid exit, the sponsor may prioritize financial milestones over long-term resilience. The Grand Master asks not only whether the asset will generate cash, but whether the ownership structure supports the life of the asset. Private equity can be a powerful steward of infrastructure when it brings patient capital, technical competence, and transparent accountability. It fails when the asset is treated as a predictable annuity, detached from the people who depend on it. The Grand Master's mantra. In infrastructure, maintenance is not a cost center. It is the promise the owner has made to the public. The Owner's Notebook. For essential assets, evaluate 4 licenses to operate: legal license, regulatory license, technical license, social license. The first 3 may be documented. The 4th can disappear without formal notice. Chapter 22. Walgreens. The return of the giant take-private. Walgreens Boots Alliance entered 2025 as a company with enormous brand recognition and serious strategic problems. The pharmacy business faced reimbursement pressure, labor challenges, changing consumer behavior, competition, underperforming stores, and the consequences of expansion into healthcare services. In March 2025, Walgreens agreed to be acquired by Sycamore Partners in a transaction with an equity value of approximately $10 billion and a total value reported around $23.7 billion, including debt and other obligations. Shareholders were offered $11.45 per share in cash, plus a contingent value right tied to future monetization of interests in VillageMD and related businesses. The acquisition closed on August 28, 2025, with Stefano Pessina and his family reinvesting their interests. The transaction illustrates why familiar brands can become difficult investments. Recognition is not the same as economic strength. A company may occupy valuable locations, serve millions of customers, and possess trusted names while its underlying model deteriorates. Retail pharmacy sits at the intersection of healthcare and consumer behavior. The stores provide essential prescriptions, but front-of-store retail competes with e-commerce, discount chains, grocery stores, and changing shopping patterns. Reimbursement economics can compress margins even when prescription volume remains high. The investment thesis must therefore separate several businesses hidden inside one company: pharmacy dispensing, retail merchandise, real estate, international operations, healthcare services, data, and customer relationships. A private owner can make changes away from quarterly public scrutiny. It can close stores, simplify reporting, sell assets, restructure management, and invest in core operations. Sycamore has experience in retail and consumer turnarounds, where speed and cost discipline can matter. But the risks are substantial. Retail turnarounds often begin with cost reduction because costs are visible and controllable. The danger is cutting the elements that sustain the customer relationship: staffing, cleanliness, inventory, convenience, and service. A pharmacy is not merely a store. Pharmacists manage complex, regulated work and serve customers who may be sick, elderly, or confused. Understaffing can create operational and reputational harm that eventually becomes financial harm. The contingent value right tied to Village MD-related assets also demonstrates how transaction structures can bridge disagreement about value. The buyer avoids paying full value upfront for uncertain assets. Sellers retain the possibility of future proceeds. Such structures can facilitate agreement, but they also create complexity and potential disputes about timing, control, and monetization. Walgreens is a test of whether private equity can repair a large legacy institution without reducing it to a liquidation exercise. The brand, pharmacy network, and customer relationships possess value. The question is whether that value can be converted into durable economics. The owner must decide what the company will stop being. Turnarounds fail when leaders attempt to preserve every historical ambition. Capital and management attention must be concentrated on the activities that still deserve to exist. The Grand Master's discipline is not to protect the old company. It is to identify the viable company inside it. The Grand Master's mantra. A famous brand is an asset only when the operating experience continues to justify the memory. Life lesson. Renewal often begins with subtraction. The difficult task is knowing what to remove without destroying what people still value. Chapter 23. Electronic Arts and the $55 billion frontier. The proposed acquisition of Electronic Arts by PIF, Silver Lake, and Affinity Partners is a defining transaction of the new private to capital era. At approximately $55 billion in enterprise value, the agreement announced in September 2025 was described by EA as the largest all-cash sponsor take-private investment in history. The $210 per share offer represented a premium to the company's unaffected share price. The consortium committed roughly $36 billion of equity and $20 billion of debt financing, with $18 billion expected to be funded at closing. The scale matters, but the composition of the consortium matters more. Silver Lake brings deep experience in technology investing. PIF brings enormous sovereign capital and has made gaming and entertainment part of a broader strategic agenda. Affinity Partners adds another source of capital and relationships. Together, the investors represent the convergence of private equity, sovereign wealth, technology, media, and geopolitical ambition. EA owns or operates some of the most recognizable franchises in interactive entertainment, including EA Sports FC, Madden NFL, Battlefield, The Sims, Apex Legends, and others. In fiscal 2026, the company reported approximately $7.5 billion in net revenue and more than $8 billion in net bookings. The investment thesis likely rests on several ideas: durable intellectual property, recurring live service revenue, global player communities, sports licensing, digital distribution, and the potential to expand engagement and monetization. Each strength contains a corresponding risk. Intellectual property is valuable, but franchises can weaken. Live services create recurring revenue, but players can reject monetization they perceive as exploitative. Sports titles benefit from annual releases and licenses, but licensing relationships are expensive and strategically important. Digital distribution improves margins, but it also increases dependence on platforms and customer trust. The consortium must therefore manage a paradox. It seeks financial certainty from a business whose products depend on creative uncertainty. That creates fixed obligations. Game development creates variable outcomes. A title can be delayed, launch poorly, or require additional investment. Creative talent can leave. A company under pressure may prioritize sequels and monetization over experimentation, weakening the pipeline that supports long-term value. The best ownership model would use private status to provide strategic patience. It could invest through development cycles, make portfolio decisions without quarterly market pressure, and align capital with long-term franchise health. The worst model would convert the company into a debt service machine. It would reduce risk by reducing creativity, producing short-term cash, while weakening the reason customers care. Another dimension. Sovereign wealth funds often possess longer time horizons than conventional buyout funds and may pursue strategic objectives alongside financial returns. This can support investment, global expansion, and ecosystem development. It can also complicate governance if the partners value outcomes differently. A consortium must answer who decides. What happens when creative leadership wants more time, lenders want cash, and strategic investors want expansion? Governance agreements can define votes, but they cannot eliminate tension. As of this edition, the transaction remained pending. That distinction is important. Announced value is not realized value. Financing commitments are not operating results. Regulatory progress is not proof of investment success. The EA deal will be judged over years by player engagement, talent retention, product quality, cash generation, balance sheet resilience, and the eventual condition of the company. The transaction may become a landmark success. It may become a warning about leverage applied to creative assets. Most likely, its truth will be more complicated. The Grandmaster question is not whether games are valuable. It is whether the ownership structure protects the creative system that produces them. The Grandmaster's mantra: never finance away the freedom required to create the product. The Owner's Notebook. For creative and technology businesses, track assets that conventional accounting understates: key talent retention, product community trust, franchise vitality, technical debt, experimentation capacity, and the willingness of customers to recommend the product. Part 5. Building the Capital Machine. Chapter 24. The Fundraising Flywheel. Private equity firms appear to make money by buying and selling companies. Their ability to continue doing so depends on another business: raising capital. A fund is a temporary mandate. Limited partners commit capital for a defined period, pay management fees, and share profits with the general partner through carried interest. Before the first fund has fully matured, the firm is often preparing to raise the next. This creates a flywheel. Strong performance attracts capital. More capital supports a larger team and broader capabilities. Greater capabilities improve access to transactions. Successful exits create realizations. Realizations strengthen the next fundraising story. When the flywheel works, growth can appear inevitable. When one link weakens, the whole system slows. Fundraising begins with trust, not marketing. Limited partners are committing to a pool of future decisions they cannot individually approve. They must believe the team will remain stable, follow the stated strategy, value assets responsibly, report bad news, and avoid conflicts. The most persuasive fundraising presentation therefore combines evidence and identity. Evidence includes realized returns, loss ratios, attribution, deal sourcing, operational results, and team history. Identity explains why the firm has an edge that will persist. Managers often overstate the edge. They describe proprietary sourcing when the deal was broadly intermediated. They attribute market multiple expansion to operations. They present unrealized gains as though they were cash. Experienced limited partners look through this language. The strongest fundraising story is specific enough to be tested. A healthcare specialist should show how sector knowledge changed decisions. A software investor should explain the metrics that allowed it to avoid weak companies. A mid-market firm should demonstrate how it helped founder-led businesses institutionalize. Fundraising also influences internal behavior. A firm preparing to market a new fund may feel pressure to sell successful assets, accelerate marks, or announce strategic initiatives. The investment team must resist decisions designed primarily to improve the narrative. The fund should not serve the fundraising process. The fundraising process should support the investment strategy. The flywheel becomes particularly powerful when a firm expands into adjacent products. A limited partner that trusts the buyout team may invest in credit, infrastructure, growth, or secondaries. Distribution relationships reduce the cost of launching new strategies. But cross-selling creates reputational contagion. Weak performance in one strategy can affect the entire platform. Investors may question whether talent is being stretched or whether the firm is using its brand to gather assets beyond its competence. The Grandmaster treats fundraising as a covenant. Capital is not applause. It is a promise to make decisions under uncertainty on behalf of people who will not be in the room. That promise should create restraint. A firm that cannot find attractive investments should slow deployment, return capital, or adjust expectations. It should not manufacture urgency because fees begin when capital is invested. The greatest fundraising advantage is the willingness to disappoint investors in the short term to protect them in the long term. The Grandmaster's mantra: capital follows performance, but durable capital follows trust. The Owner's Notebook. A fundraising claim should answer 3 questions. What specific evidence supports it? What evidence would disprove it? Does the claim describe the future opportunity or merely the past environment? Doubling a $2 billion company creates $2 billion of value. Doubling a $50 billion company creates $50 billion, but the operational challenge is far greater. Large companies have complex systems, entrenched cultures, unions, regulators, public visibility, and fewer obvious improvements. Returns may therefore depend more heavily on entry price, financing, market movement, and large strategic changes. The best mega fund managers use scale to reduce risk rather than merely increase deal size. They write larger equity checks, maintain liquidity, build sector specialization, and use portfolio resources. They can underwrite long-term transformations that smaller funds cannot support. Co-investment has become an important part of the structure. Limited partners may invest directly alongside the fund in specific deals, often with reduced fees. Co-investment allows the sponsor to pursue larger transactions without concentrating the main fund excessively. It also helps limited partners increase exposure to selected assets. But co-investment creates allocation questions. Which investors receive access? Are the best deals shared or retained? Does the sponsor feel pressure to complete a transaction because co-investors have spent time on it? Governance must ensure that the main fund's interests remain primary. A mega fund is not simply a larger version of a small fund. It is a different organism. Its sourcing, decision-making, portfolio construction, and succession systems must match the scale. Capital becomes an advantage when the firm can remain selective despite abundance. The Grand Master's Mantra: capital is an advantage until it becomes a mandate to act. Life lesson: having more resources does not reduce the need for discipline. It increases the number of ways discipline can be lost. Chapter 26: The Difference Between AUM and Greatness. Assets under management is one of the most quoted numbers in private markets. It is also one of the most frequently misunderstood. AUM may include private equity, credit, real estate, infrastructure, insurance assets, hedge funds, secondaries, and other strategies. Two firms with similar AUM can have completely different economics, risk, and investment capabilities. As of 2026, Blackstone reported more than $1.3 trillion in AUM. Apollo reported approximately $1.03 trillion as of March 31st. Brookfield Asset Management described itself as managing more than $1 trillion. KKR reported hundreds of billions across strategies. Carlyle reported approximately $475 billion. EQT reported 269 billion euros. CVC reported more than 200 billion euros across private market strategies. These numbers establish scale. They do not rank investment quality. Private Equity International's PEI 300 uses a different metric, qualifying private equity capital raised from third-party investors during a 5-year period. In the 2026 ranking, KKR placed first with approximately $140.4 billion, EQT second with approximately $134.4 billion, and Blackstone third with approximately $111.8 billion. This ranking does not say that KKR has the most total assets or that every KKR fund outperformed every competitor. It measures fundraising volume under defined rules. Other measurements include fee-earning AUM, perpetual capital, dry powder, realized proceeds, distributable earnings, net accrued performance revenue, and market capitalization. Each answers a different question. AUM can grow because of strong performance, new fundraising, acquisitions of other managers, insurance assets, market appreciation, or changes in measurement. The quality of the assets and fee rates may differ. Greatness should therefore be examined through a broader scorecard. Net returns to investors, consistency across vintages, loss ratio, realized versus unrealized performance, responsible use of leverage, portfolio company development, team stability, governance, and the ability to retain trust through difficult periods. Even return measures require care. Internal rate of return rewards speed and can be influenced by subscription credit lines or early distributions. Multiple on invested capital shows total value, but ignores time. Gross returns exclude fees and carried interest. Net returns reflect the investor experience, but may vary by share class, timing, and currency. A single deal can produce a spectacular multiple while the fund performs modestly. A fund can produce a strong IRR through quick exits without creating the most total value. A mature fund with realized proceeds is easier to evaluate than a young fund marked on internal valuations. The Grand Master does not search for one perfect metric. She uses multiple measures and understands the incentives each creates. AUM is valuable because it signals the scale of responsibility. The larger the number, the more employees, retirees, institutions, and families depend on the manager's judgment. It should create humility, not celebration. The Grandmaster's Mantra. Size tells you how much capital has been entrusted. It does not tell you how wisely it will be used. The Owner's Notebook. When comparing managers, request a bridge from gross to net performance, realized to unrealized value, and market movement to operating improvement. Attribution is where marketing becomes analysis. Chapter 27. The Limited Partner's View. General partners speak the language of opportunity. Limited partners must speak the language of portfolio construction. A pension fund, endowment, insurer, sovereign wealth fund, or family office does not evaluate a manager in isolation. It considers liquidity, risk, vintage diversification, currency, sector exposure, governance, and how the fund interacts with the rest of the portfolio. The limited partner begins with performance but cannot end there. Track records require attribution. Did returns come from one exceptional deal? Were losses hidden inside unrealized marks? How much value came from leverage, revenue growth, margin improvement, acquisitions, or exit multiples? Did the professionals responsible for the results remain at the firm? Team stability is critical because investors commit to future decisions. A famous founder may attract capital, but the fund will be deployed by a broader organization. The LP must understand who sources, underwrites, monitors, and ultimately decides. Key person provisions provide legal protection if senior leaders leave, but legal protection does not recreate the team. The better defense is an institution with distributed judgment, transparent succession, and incentives that retain the next generation. Strategy drift is another concern. A manager may raise a fund for mid-market healthcare and later pursue larger technology deals because the market changed or the firm grew. Flexibility can be useful, but drift undermines the reason the LP made the allocation. Fees matter because private equity compounds gross performance and subtracts costs. Management fees carried interest, transaction fees, monitoring fees, fund expenses, financing costs, and taxes affect the investor's outcome. Large institutions negotiate terms, while smaller investors may accept standard structures. Co-investment can reduce the blended fee load and allow targeted exposure. It also requires resources. The LP must evaluate a company quickly, monitor it, and manage concentration. Free or low-fee access is not automatically attractive. Liquidity is often underestimated. Private equity capital is called over time and returned unpredictably. During market stress, distributions may slow while capital calls continue. The LP must maintain enough liquid assets to meet obligations without selling at poor prices. The denominator effect can make this worse. If public markets fall, private assets may become a larger share of the portfolio, even before private valuations adjust. An institution may then appear overallocated and stop making commitments precisely when new vintages could be attractive. The strongest LP programs manage pacing across cycles. They avoid committing only after strong industry performance and retreating after weak markets. They understand that vintage diversification is a form of risk control. Family offices face additional questions. They may have greater flexibility, but less institutional process. A founder or family member may be attracted to famous names, exclusive access, or a charismatic manager. Governance must protect the portfolio from social influence disguised as diligence. The LP's deepest responsibility is to remember whose money is being invested. Pension assets belong to workers. Endowment assets support future students and research. Family capital may carry obligations across generations. The manager selection process should therefore be demanding without becoming cynical. Great partnerships are built when the LP understands the strategy and the GP treats the capital as a long-term relationship rather than a fundraising transaction. The Grand Master's Mantra. Select the people who will make the next decision, not the brand that made the last one. The LP checklist. Net, realized, and vintage-adjusted performance. Loss ratio and concentration. Team attribution and turnover. Governance and conflicts. Strategy consistency. Valuation policy. Fees and expenses. Liquidity and pacing. And succession. Chapter 28. The Family Office Advantage. A family office can possess something institutional investors often lack: freedom. It may invest directly, hold indefinitely, concentrate capital, move quickly, support entrepreneurs through difficult periods, or decline an opportunity without worrying about an annual deployment target. This flexibility can be a profound advantage. It can also become a source of disorder. Family capital often carries multiple objectives. It may seek financial return, preservation of wealth, operating influence, legacy, philanthropy, or opportunities for the next generation. Unless those objectives are made explicit, investments can be judged by shifting standards. The strongest family offices begin with governance. They define who has authority, how risk is measured, which decisions require family approval, and how conflicts are handled. They separate investment work from family status. A senior family member may possess experience and intuition, but intuition should enter a process. Younger members may bring technology knowledge or new networks, but access should not substitute for underwriting. Family offices can also invest without the fixed life of a private equity fund. This allows them to own exceptional businesses through multiple cycles and avoid selling merely because a fund is ending. Permanent capital changes the question from who will buy this from us to would we be comfortable owning this for 20 years? That question improves discipline. It emphasizes management, competitive advantage, reinvestment opportunity, and culture. It reduces dependence on exit multiples, yet indefinite ownership can create complacency. A family may retain an asset because of history, identity, or emotional attachment, even when the economics deteriorate. Patient capital must still be accountable capital. Direct investing offers fee savings and control, but it requires infrastructure. The office needs sourcing, diligence, legal expertise, portfolio monitoring, and operating support. A small team may underestimate the demands of ownership after closing. Co-investment and partnerships with established sponsors can bridge the gap. The family office gains access and learns alongside experienced investors. It must still perform independent diligence and understand whether the sponsor's time horizon aligns with its own. The family office advantage is strongest in situations where trust, patience, and flexibility matter. Founder transitions, complex family businesses, long-duration assets, and companies that need strategic capital without an immediate exit. Its disadvantage is the possibility of informal decision-making. Social relationships, prestige, and loyalty can influence capital allocation. A deal introduced by a friend may receive less scrutiny than one sourced through a professional process. The office should therefore create institutional memory. It should record why an investment was made, which assumptions mattered, and what outcome would trigger action. Without records, every success becomes proof of genius, and every failure becomes an exception. The family office is not merely an investment organization. It is a bridge between generations. Its task is to preserve the capacity to choose, not only the amount of wealth. The Grand Master's mantra: patient capital is powerful only when patience is paired with governance. Life lesson: freedom without structure becomes impulse. Structure without freedom becomes bureaucracy. The art is preserving both. Chapter 29. Women Rewriting the Private Markets Playbook. Private equity was built inside networks that were historically narrow. Deal teams, lender relationships, boards, and senior partnerships were dominated by men. The industry has changed, but representation at the highest levels remains uneven. The most meaningful way to examine women in private markets is not to create a ceremonial list. It is to study the work: capital formation, sector leadership, operating transformation, secondaries, firm building, and investment judgment. Jennifer James serves as Managing Director, Chief Operating Officer, and Head of Investor Relations and Marketing at Thoma Bravo. Her role demonstrates that a private equity firm's competitive position depends on more than deal execution. Investor trust, organizational strategy, communication, operations, and culture are central to the platform. Catherine Petty became co-head of North American Private Equity and global head of healthcare at CVC, with responsibilities spanning regional strategy and a sector where scientific understanding, regulation, and human outcomes intersect. Sylvia Oteri, partner and global head of healthcare at Primera, has worked across pharmaceuticals, medical technology, diagnostics, and healthcare services. Her public comments emphasize partnership with families and management teams, a reminder that relationship quality can influence transaction access and post-closing execution. Gabrielle Ellie Rubenstein co-founded Mana Tree, an investment firm focused on health and wellness. Building a firm around a defined mission requires proving that thematic conviction can produce financial discipline rather than substitute for it. Other prominent women have led consumer investing, industrial transformations, secondaries, healthcare, education, and growth strategies. Their influence extends from investment committees to operations and fundraising. The industry benefits from diversity for reasons more demanding than fairness alone. Homogeneous teams can share blind spots. They may interpret agreement as evidence and familiarity as quality. Different professional and personal experiences can improve the range of questions asked. Diversity does not automatically produce better decisions. Teams must create conditions in which disagreement is heard. A diverse group that rewards conformity will reproduce the same errors with different faces. The private equity career model also deserves examination. Advancement often depends on apprenticeship, deal attribution, travel, long hours, and access to senior sponsorship. Parenting, caregiving, and informal networks can affect who remains in the pipeline. Firms that want broader leadership must redesign systems, not merely recruit entry-level classes. They must examine promotion, economics, deal leadership, parental support, mentorship, and who receives the opportunities that build a track record. The next generation of grandmasters will be judged by performance, but performance will be created inside institutions capable of attracting talent from a wider field. The deeper lesson is that leadership in private equity has multiple forms. The person negotiating the purchase price is visible. The person who builds investor confidence, recruits the operating team, manages risk, or creates an institutional culture may be equally important. Private markets are becoming larger, more regulated, more global, and more connected to individual savers. The industry's leadership must become more complete as its responsibility expands. The Grand Master's mantra. Better decisions begin when the room contains more than one way of seeing the problem. The Owner's Notebook. Do not measure inclusion only by headcount. Measure who controls capital, leads deals, receives economics, influences investment committees, and succeeds the founders. Chapter 30. The New Private Capital Ecosystem. Private equity once described a relatively clear structure. Raise a closed-end fund, acquire companies, improve them, sell them, and distribute the proceeds. The modern ecosystem is far more complex. Private credit finances companies that might once have borrowed from banks or issued public debt. Continuation funds allow sponsors to hold assets beyond the original fund life while providing liquidity to existing investors. GP-led secondaries create transactions in which the sponsor helps arrange the transfer of assets from one vehicle to another. Insurance balance sheets provide long-duration capital. Evergreen funds offer periodic subscriptions and limited liquidity. Wealth management channels bring private markets to individual investors. Each innovation solves a real problem. Private credit can provide speed, certainty, and customized terms. Continuation vehicles can prevent the forced sale of a high-quality company. Secondaries can provide liquidity in an illiquid asset class. Permanent capital can support long-duration strategies. Retail access can broaden participation in investments historically limited to institutions. Each innovation also creates conflicts. When a sponsor sells an asset from one fund to a continuation vehicle, it also manages. It may stand on both sides of the transaction. Existing investors may want liquidity. New investors want an attractive price. The sponsor may want to preserve upside and continue earning fees. Independent valuation, investor choice, and transparent process are essential. Private credit can support companies, but it may also permit leverage that traditional banks would reject. Customized documents can offer protection, yet intense competition can weaken terms. When the cycle turns, the flexibility of private lenders will be tested. Insurance capital can match long-duration liabilities with private assets. It can also create opacity if policyholder promises are supported by complex or illiquid investments. Regulators and rating agencies will continue examining the connection. Retail alternatives raise questions of suitability, fees, valuation, and liquidity. Institutional investors have teams capable of evaluating complex structures. Individual investors may rely on advisors or product materials. Access must be accompanied by clear explanation of lockups, risks, and costs. The convergence of strategies changes private equity firms into financial institutions. They originate loans, manage insurance assets, own infrastructure, advise companies, and distribute products to individuals. This scale brings systemic importance. The industry must therefore develop governance equal to its influence. Conflicts cannot be managed through disclosure alone. Boards, valuation committees, compliance systems, and client protections must be designed for organizations that operate across the capital structure. The opportunity is significant. Public markets contain fewer listed companies than in earlier decades, and much corporate growth occurs in private markets. Private capital can fund innovation, infrastructure, energy transition, healthcare, and business transformation. The risk is that private markets become too private, too complex for clients to understand, too interconnected for regulators to monitor, and too dependent on valuations that adjust slowly. The Grand Master welcomes innovation, but asks who bears the risk, who sets the price, and who can exit when confidence changes. The Grand Master's mantra. Financial innovation creates value when it solves a client's problem without hiding the transfer of risk. Life lesson. Complexity should create capability, not confusion. Part 6. The Grand Master's Playbook. Chapter 31. Find the truth before you find the deal. Private equity firms are rewarded for completing transactions, but investment success begins before a transaction exists. The strongest investors develop a view of industries, companies, and management teams before an auction forces them to decide quickly. They study markets continuously, build relationships, and create hypotheses about where value may appear. This is called sourcing, but the word can make the work sound mechanical. Real sourcing is an act of preparation. It's the process of becoming useful and credible enough that owners, executives, advisors, and lenders choose to speak with you before they must. A proprietary opportunity is not simply a deal with no banker. It is a situation in which the investor possesses an insight, relationship, or solution that changes the probability of winning and the quality of the outcome. The truth is often hidden by incentives. Sellers emphasize potential. Management protects its record. Advisors want the transaction to close. Lenders earn fees by financing it. Investment professionals may want deal attribution and promotion. The investor must therefore design diligence to produce disagreement. Customer interviews should include former customers, not only references selected by management. Market studies should ask what could shrink the industry, not only how fast it may grow. Management assessment should examine decision quality under pressure, not charisma in a presentation. A good diligence process separates facts from interpretations. Fact. Customer concentration increased. Interpretation. The company is winning larger enterprise accounts. Alternative interpretation. Smaller customers are leaving. The investment committee should know which statements are observed and which are inferred. Truth also requires emotional distance. Once a team spends months on a deal, the cost of walking away feels personal. Work, travel, relationships, and reputation have been invested. The team begins to search for modifications that preserve the transaction. This is the sunk cost trap. The money already spent on diligence is insignificant compared with the capital that may be lost after closing. Grandmaster firms create explicit walkaway conditions before the process becomes emotional. They identify the maximum price, minimum management quality, required financing flexibility, and facts that would invalidate the thesis. They also reward people who surface bad news. In a weak culture, the junior professional who identifies a fatal problem is seen as obstructive. In a strong culture, that person protects the fund. The truth may be that the company is excellent but overpriced. It may be that management is exceptional but the market is deteriorating. It may be that the deal works only with leverage unavailable on acceptable terms. Walking away does not mean the work was wasted. The firm has learned an industry, built relationships, and established a valuation boundary. That knowledge may create the next opportunity. The best investors do not fall in love with deals. They fall in love with understanding. The Grand Master's mantra. The first duty of diligence is not to confirm the opportunity. It is to discover the reason not to proceed. The Owner's Notebook. Create a one-page truth sheet containing 5 facts that support the thesis, 5 facts that weaken it, the 3 largest unknowns, the assumption most likely to be wrong, and the event that requires walking away. Chapter 32. Underwrite the business, not the spreadsheet. A financial model is a language. It allows investors to express assumptions about revenue, margins, cash flow, debt, and value. Like any language, it can communicate truth or conceal confusion. The model becomes dangerous when precision is mistaken for knowledge. Revenue may grow at 8.3% because a formula requires a number. The real business will grow through customers making decisions. Some will renew, some will leave. Salespeople will be hired or fail. Competitors will respond. Products will improve or disappoint. Underwriting the business means connecting every important number to an operating cause. Revenue growth should be decomposed into price, volume, retention, new customers, product mix, and acquisitions. Margin expansion should be tied to specific changes in procurement, labor, automation, utilization, or overhead. Working capital should reflect how customers pay and suppliers negotiate. The investor should understand which assumptions management controls and which belong to the market. A company can control sales effort, product quality, hiring, and cost discipline. It cannot control interest rates, regulation, competitor financing, or consumer confidence. The more value depends on external variables, the more conservative the structure should be. Revenue quality deserves special attention. Contracted revenue is not always secure. Contracts may permit cancellation, depend on usage, or renew at customer discretion. Recurring revenue can be concentrated in a few customers. Backlog can contain low-margin work. The investor must ask how revenue behaves under stress. Do customers reduce volume? Can they delay purchases? Does the product save money, create revenue, satisfy regulation, or merely improve convenience? The closer the product is to a customer's essential workflow, the more durable the relationship may be. But even mission-critical products can face pricing pressure or technological substitution. Management depth is equally important. A business dependent on one founder, salesperson, engineer, or regulator relationship carries hidden concentration. The model may assume the company can double while the organization cannot absorb the growth. Capital expenditure is often underestimated. Maintenance spending may be labeled growth investment or deferred to improve near-term cash. Technology debt, equipment replacement, cybersecurity, and compliance can require capital that historical statements do not reveal. The Grand Master walks through the business physically and conceptually. She follows an order from customer acquisition to delivery to payment. She asks where errors occur, where cash becomes trapped, and which employee understands a process no one else can perform. The spreadsheet should be the final expression of that understanding, not the source of it. A model cannot tell you whether a customer is angry, whether a plant manager is exhausted, or whether a product roadmap has become fiction. Those truths must enter the model from the world. The Grand Master's mantra. Every important cell should have an operating story, and every operating story should survive contact with evidence. The owner's notebook. For each major assumption, write: who controls it? What evidence supports it? How quickly it can change? And what leading indicator will show deterioration before the financial statements do? Chapter 33. Price is a decision about the future. Valuation appears to be a statement about the present. In reality, price is a set of beliefs about the future. A buyer paying 12 times EBITDA is not merely accepting a market multiple. She is making assumptions about growth, margins, cash conversion, leverage, and the valuation at exit. The multiple compresses those assumptions into one number. This is why comparable company analysis can become lazy. Similar companies may deserve different values because their customer retention, capital intensity, management quality, competitive position, and growth durability differ. The investor should build value from cash flows and scenarios, then use multiples as a reasonableness check. If the transaction works only because the exit multiple exceeds the entry multiple, the return is partly a forecast about future investor enthusiasm. Multiple expansion can occur. A company may become larger, more diversified, faster growing, or less risky. The owner may deserve credit for changing the quality of the business. But multiple expansion without business improvement is market dependence. Price also determines behavior after closing. A high entry valuation creates pressure to grow quickly, reduce costs, add leverage, or pursue acquisitions. The company may take risks not because they are attractive, but because the purchase price requires them. The margin of safety is therefore not simply a discount. It is the distance between the expected future and the future required to avoid loss. A business purchased at a modest price can survive disappointment. A wonderful business purchased at an extreme price may produce a poor return despite performing well. The investment committee should ask what must be true to earn the target return. If revenue must grow faster than the market, margins must reach the industry high, debt must decline on schedule, and the exit multiple must remain elevated. The thesis contains too many simultaneous requirements. A strong deal can tolerate one or two disappointments. Price discipline is hardest in competitive markets. Advisors present scarcity. Rival bidders signal confidence. The team may argue that the company is uniquely strategic or that the firm will not see another opportunity. Scarcity is sometimes real. Exceptional assets are rare, but rarity does not eliminate arithmetic. The Grand Master defines a price range and the evidence required to move within it. She does not increase the price because the process became exciting. She increases it only if new information increases value. She also distinguishes between value to the company and value to the specific buyer. A strategic owner may realize synergies unavailable to a financial sponsor. A sponsor with an existing platform may have a unique cross-selling opportunity. Those advantages can justify a higher price, but they should be quantified and risk-adjusted. The most dangerous phrase in valuation is, "we can make it work." Nearly any model can be made to work by adjusting assumptions. The investor's obligation is to determine whether the business is likely to work without requiring exceptional fortune. The Grand Master's mantra: the price becomes dangerous when the story must be perfect. Life lesson: what you pay determines how much reality is allowed to disappoint you. Chapter 34: Negotiation without theater. Popular culture presents negotiation as domination, dramatic ultimatums, hidden tricks, and the moment one side defeats the other. Private equity negotiations are often quieter. They involve price, financing certainty, management roles, representations, indemnities, rollover equity, governance, and hundreds of details that determine who bears risk after closing. The strongest negotiator begins with preparation. She knows the economics, the alternatives, the other party's priorities, and the terms that matter more than price. A seller may care about employee continuity, brand preservation, speed, or retaining equity. A sponsor may be able to offer certainty or partnership that a higher bidder cannot. This creates value through structure. Negotiation also requires credibility. A buyer that retrades every issue may achieve a lower price but lose trust. A seller may choose a slightly lower offer from a party believed to close. Reputation becomes an economic asset. Silence is useful because people reveal priorities when they are not immediately answered. But silence should not become performance. The objective is understanding, not discomfort. The Grand Master separates positions from interests. Position: we need $500 million. Interest: we need enough after-tax proceeds to fund retirement and provide liquidity to family shareholders. A transaction may solve the interest through rollover equity, tax structure, or staged consideration, even if the headline price differs. Management equity is another critical negotiation. The sponsor wants alignment. Executives want fair participation and protection if circumstances change. The terms should reward value creation without encouraging manipulation or excessive risk. Badly designed incentives create distrust before ownership begins. If management believes the sponsor can change the rules, alignment is fictional. The ability to walk away remains the greatest source of negotiating strength. A buyer dependent on one deal will overpay or accept weak terms. A seller facing liquidity pressure may concede too much. Alternatives should be developed before the negotiation. The sponsor can pursue other targets. The seller can refinance, remain independent, or approach other buyers. A clear alternative reduces emotional dependence. Ethics matter because private equity is a repeated game. Advisors, lenders, executives, and investors meet again. A short-term advantage gained through deception can reduce future access. This does not require softness. A negotiator can be firm, protect capital, and demand evidence. The distinction is between toughness and bad faith. The closing should leave both parties able to explain why the agreement made sense. If one side feels humiliated, the post-closing relationship begins with resentment. The Grand Master's mantra: the best negotiation creates certainty about what matters and flexibility about what does not. The Owner's Notebook. Before negotiating, list the 3 non-negotiable terms, the terms that appear important but are exchangeable, the other party's likely interests, the value of speed and certainty, and the point at which walking away improves the expected outcome. The first 100 days after closing receive enormous attention because they create momentum and reveal whether the sponsor's diligence was real. The period should not be a performance of activity. It should establish clarity. The company needs to know what will change, what will remain, who decides, and how progress will be measured. Employees are often anxious. Customers may wonder whether service will deteriorate. Managers may fear replacement. Silence creates rumors. The owner should communicate quickly without making promises it cannot keep. The first priority is liquidity. The sponsor must understand cash, working capital, debt obligations, and near-term risks. A company can survive strategic confusion for a period. It cannot survive missing payroll or a required payment. The second priority is management assessment. The deal team has met senior leaders during diligence, but ownership reveals behavior under pressure. Who communicates bad news? Who solves problems? Who protects territory? Who possesses the trust of employees and customers? Replacing management immediately can create disruption. Retaining the wrong leader can waste the most valuable year. The decision should be based on capability, values, and fit with the plan, not merely whether the person supported the transaction. The third priority is the operating cadence. Weekly and monthly reviews should focus on leading indicators, not produce endless presentations. The board should know revenue, cash, customers, employees, operational risk, and progress against the value creation plan. The fourth priority is focus. The diligence process may generate dozens of initiatives. Attempting all of them overwhelms the organization. The owner should choose a few priorities capable of changing the trajectory. A strong 100-day plan might include pricing, sales organization, procurement, working capital, leadership, technology, or a product decision. Each initiative needs an owner, milestones, resources, and a definition of success. The sponsor should also identify what not to change. A company may possess a strong culture, loyal customer service, or entrepreneurial speed. Professionalization should not become sterilization. Private equity owners sometimes introduce reporting systems designed for the fund rather than the company. Management spends hours translating operations into sponsor language. The better approach is to build a system that helps management run the business and allows the owner to see the truth. The first 100 days also establish the relationship between board and management. The board should challenge assumptions, remove obstacles, recruit talent, and allocate capital. It should not become a shadow management team. Intervention is most useful when the company lacks a capability or faces a decision that benefits from the sponsor's experience. Constant intervention teaches management to wait for approval. The Grand Master uses the first 100 days to create confidence without creating dependence. The Grand Master's mantra: move quickly to establish truth and direction. Move carefully when changing people and culture. The 100-day agenda. Confirm liquidity and covenant headroom. Validate the investment thesis against post-closing data. Assess leadership and critical talent. Select 3 to 5 priorities. Establish decision rights and operating cadence. Communicate with employees, customers, and lenders. Identify the strengths that must not be damaged. Chapter 36. Build value that survives the exit. Private equity value creation is often divided into revenue growth, margin expansion, debt reduction, and multiple change. The categories are useful, but they do not distinguish durable improvement from temporary optimization. A price increase can create value. If it reflects improved product value and customers remain loyal, the value is durable. If customers accept it only because contracts prevent immediate departure, the revenue may reverse later. A cost reduction can create value. Eliminating unnecessary overhead or improving procurement strengthens the company. Cutting maintenance, training, or product development borrows from the future. An acquisition can create value. It may add customers, technology, talent, or geographic reach. It may also hide weak organic growth and create integration debt. The owner should ask whether the company will remain better after the sponsor exits. Durable value usually comes from capabilities: a stronger management team, a differentiated product, loyal customers, better data and systems, disciplined capital allocation, scalable processes, and a culture capable of adapting. These assets may not produce immediate EBITDA. They improve the probability of future cash flow. Organic growth is particularly valuable because it demonstrates customer demand. It can be created through pricing, new products, better sales execution, geographic expansion, or higher retention. The sponsor should understand the quality of each growth dollar. Revenue gained through unsustainable discounts may reduce value. Revenue concentrated in one customer increases risk. Revenue requiring excessive capital may not improve equity returns. Talent is another source of durable value. Private equity firms often recruit executives, but the deeper task is building a leadership bench. A company becomes more valuable when it can operate without one indispensable person. Technology investment can increase efficiency and customer value, but large systems are risky. The owner should prioritize clear use cases, responsible implementation, and adoption. Buying software does not create digital transformation. Working capital improvements can release cash by managing inventory, collections, and payables. The improvement should not damage supplier relationships or customer service. The board must also protect the company from initiative overload. Every department can produce a list of improvements. The organization needs sequencing. Capabilities should be built in an order that supports the next stage. A sponsor may be tempted to maximize reported EBITDA before sale. Aggressive adjustments, delayed spending, and optimistic forecasts can improve the marketing narrative. Sophisticated buyers will examine the quality of earnings and the condition of the organization. Even if a buyer pays, passing a weakened company to the next owner damages reputation and eventually reduces access. The greatest private equity exit is not merely a high price. It is a transaction in which the next owner can see a company worthy of confidence. The Grand Master's mantra: build value that a buyer can verify and a company can keep. The Owner's Notebook. For every value creation initiative, ask, does it improve customer value? Does it create a repeatable capability? Does it require underinvestment elsewhere? Will the benefit remain after the current leaders leave? Can a future owner verify it without trusting our narrative? Chapter 37. Anderson Fox. The owner's lens on deals and shareholder value. The meeting had gone long enough for the polished language to begin losing its power. The seller's presentation had promised a familiar combination: recurring revenue, loyal customers, experienced employees, attractive margins, and a market large enough to support years of growth. The financial model showed a clean upward line. The acquisition case appeared disciplined. The downside case still produced a return. Then Anderson Fox asked the question that changed the room. What must go right for this deal to work? That question captures the discipline at the center of Fox's approach. He does not begin by asking how attractive the upside can look in a presentation. He begins by finding the conditions the business must survive, the assumptions the buyer can actually control, and the operating changes that can turn ownership into durable shareholder value. It is one of the simplest questions in private equity, and one of the most revealing. A transaction can survive one uncertain assumption. It may survive two. But when the investment case requires customer retention, margin expansion, flawless integration, cooperative lenders, a strong economy, and a higher exit multiple, the model is not describing resilience. It is describing dependence on perfection. Across more than 2 decades in mergers and acquisitions, corporate finance, investment banking, and private equity, Fox developed a way of examining transactions that begins with skepticism, but does not end there. The purpose is not to find reasons to reject every opportunity. It is to identify the few truths that determine whether ownership can create value. As a managing partner at Enpoda, Fox has worked across sectors including healthcare, technology, financial services, home services, and founder-owned businesses. The industries differ. The underlying questions do not. Is the cash flow real? Can the company operate without the seller? What is the customer actually buying? Where is value leaking? Which improvements are within the owner's control? How much debt can the business carry through an ordinary year rather than an exceptional one? And after the fees, financing, disruption, and risk, will the company become stronger than it was before the acquisition? Fox's stated philosophy is direct. Capital should build, not strip, value. That principle sounds moral, but it is also economic. A business weakened to produce a temporary distribution may create an attractive quarter and a poor investment. A company strengthened through better systems, management, pricing, customer service, and capital discipline can continue compounding after the original owner has left. Begin with the cash, not the story. Every deal arrives with a story. The founder built a respected brand. The market is fragmented. Competitors are unsophisticated. Technology will improve margins. Acquisitions will accelerate growth. A new sales leader will unlock demand. Some stories are true, some are partially true. Others are narratives assembled to make the price appear reasonable. Fox begins with the cash, not reported EBITDA alone, not adjusted EBITDA after every inconvenient expense has been renamed non-recurring, not revenue that exists on paper but arrives late, requires heavy working capital, or depends on one customer. He examines how money enters the company, how long it remains, where it leaves, and which parts of the cash flow are repeatable. A business can report attractive earnings while consuming cash because inventory is rising, customers are paying more slowly, capital expenditures are being deferred, or aggressive revenue recognition is pulling tomorrow's sales into today. The owner therefore reconstructs the economic engine: revenue by customer, product, geography, and contract type; gross margin by service line or product; customer acquisition and retention costs; normalized maintenance capital expenditure; working capital requirements; owner compensation and related party expenses; concentration among customers, suppliers, and employees, and the timing difference between accounting profit and cash collection. This is not merely financial diligence. It is an attempt to discover the business beneath the financial statements. When the cash conversion is poor, Fox asks whether the cause is operational or structural. Poor collections may be fixable. A business model that requires constant working capital investment may not be. Excess inventory may reflect weak purchasing controls. It may also reveal obsolete products that management has avoided writing down. The distinction determines value. Separate a good company from a good deal. A company can be excellent and still be a poor acquisition. The most admired business in an industry may command a price that leaves no room for ordinary disappointment. The buyer may be correct about the company and wrong about the investment. Fox separates business quality from transaction quality. Business quality includes customer loyalty, competitive advantage, management depth, cash generation, market position, and the ability to reinvest at attractive returns. Transaction quality includes price, structure, financing, representations, working capital terms, seller participation, earnouts, rollover equity, indemnification, and the amount of time the owner has to execute the plan. The two scores should not be blended. A mediocre company purchased at a low price is not automatically attractive because operational problems may be expensive or impossible to repair. A wonderful company purchased at an extreme price is not automatically safe because its future must justify expectations already embedded in the valuation. Fox looks for alignment between the quality of the asset and the forgiveness built into the structure. A volatile company should not carry a fragile capital structure. A business dependent on the founder should not be priced as though the management transition has already succeeded. A company requiring heavy investment should not be acquired with a model that assumes every dollar of cash flow can reduce debt. The best deal is not necessarily the lowest price deal. It is the transaction in which the risks are understood, allocated, and financed honestly. Underwrite the transfer of control. Many acquisitions fail because the buyer studies the company but underestimates the transfer. The seller may own the customer relationships. The founder may approve every meaningful decision. Employees may remain loyal to a person rather than an institution. Suppliers may provide favorable terms because of a relationship that disappears at closing. Fox treats transferability as a separate diligence category. He asks, which customers would notice immediately if the owner disappeared? Who holds the technical knowledge that has never been documented? Which decisions stop when the founder goes on vacation? What promises have been made informally to employees, vendors, or customers? Does the second layer of management possess authority or merely titles? Can the company produce reliable information without the seller interpreting it? The answers affect both price and structure. Seller rollover equity can preserve alignment. Earnouts can connect consideration to performance, though poorly designed earnouts often create conflict. Transition agreements can transfer knowledge, but they cannot manufacture leadership. Retention plans can protect key employees, yet money alone will not repair a culture that feels ignored or threatened. The buyer must decide whether the company is being purchased as an operating institution or as an extension of the founder. The difference becomes visible only after control changes hands. Build the downside before celebrating the upside. Most acquisition models devote more imagination to growth than to failure. The upside case receives new locations, acquisitions, price increases, sales productivity, and multiple expansion. The downside case often reduces revenue by a few percentage points and delays the exit. Fox reverses the sequence. Before asking how large the return can become, he asks how the investment can be damaged. What happens if the largest customer leaves? What happens if the labor cost rise in prices? What happens if the integration takes twice as long? What happens if the lender reduces availability? What happens if the owner cannot complete the planned acquisitions? What happens if the exit multiple is lower than the entry multiple? The purpose is not pessimism. It is to identify the company's survival requirements. A resilient deal should retain options under pressure. It should have enough liquidity to fund payroll, suppliers, taxes, and necessary investment. The covenants should leave room for volatility. The ownership group should know in advance whether it is willing and able to provide additional capital. Fox evaluates debt against the company's least impressive normal year, not its best recent year. He examines fixed charge coverage, seasonality, working capital swings, capital expenditure, and the consequences of delayed improvement. Debt can improve discipline. It can also remove the time required to solve the problem the buyer acquired. Identify the few levers that matter. A weak value creation plan is a long list of possibilities. A strong plan identifies the small number of actions that can materially change the business. Fox organizes value creation around controllable levers. The first is revenue quality. Can the company improve retention, strengthen contracts, reduce customer concentration, or focus on higher value offerings? The second is pricing. Does the company understand the value it delivers, the cost to serve each customer, and the relationship between price and retention? The third is operating discipline. Are labor, procurement, scheduling, inventory, and overhead managed through repeatable systems or individual heroics? The fourth is management depth. Can the organization make decisions without the founder or sponsor? Are responsibilities clear? Is performance measured? Are incentives connected to long-term enterprise value rather than short-term activity? The fifth is capital allocation. Which initiatives deserve investment? Which acquisitions genuinely strengthen the platform? Which projects consume cash without creating capability? The sixth is data. Can the company produce timely, trustworthy information about customers, margins, productivity, cash, and risk? Not every deal requires all six. The discipline lies in identifying which 2 or 3 will determine the outcome. When a plan contains 20 equal priorities, it contains no priorities. The first 100 days begin before closing. Fox does not treat the first 100 days as a ceremonial period that begins after the wire transfer. The work begins during diligence. The buyer should know which information must be available on the first day, which employees must be retained, which customer relationships need immediate attention, which financial controls require repair, and which decisions should be deliberately weighed. Speed matters, but sequencing matters more. The first objective is stability. Employees need to understand what is changing and what is not. Customers need reassurance. Lenders need reliable reporting. Management needs a clear decision structure. The second objective is truth. The new owner must establish a dependable weekly and monthly operating rhythm. Cash, sales, margins, backlog, collections, customer issues, and staffing should become visible without creating a bureaucracy that overwhelms the company. The third objective is focus. The owner should select a limited number of initiatives with accountable leaders, measurable outcomes, and realistic timelines. The fourth objective is capability. The company should become better able to make decisions after the sponsor's involvement, not more dependent on it. This is where shareholder value is actually created, not in the acquisition announcement, not in the model, not in the board presentation. Value is created when the company can serve customers more effectively, generate cash more reliably, allocate capital more intelligently, and operate with less dependence on one person. Shareholder value is an output. The phrase shareholder value is often used to justify almost any action that improves near-term financial performance. Fox's approach treats shareholder value as an output of enterprise improvement, rather than a substitute for it. A company does not become more valuable merely because expenses were cut. It becomes more valuable when unnecessary cost is removed without damaging the capabilities required to compete. A company does not become more valuable merely because debt was added. It becomes more valuable when capital is deployed at returns above its cost, while resilience is preserved. A company does not become more valuable merely because it completed acquisitions. It becomes more valuable when those acquisitions improve customer reach, talent, technology, economics, or strategic position after integration costs are considered. The owner therefore tracks both financial and operating evidence. Financial evidence includes cash conversion, margins, return on invested capital, debt reduction, and earnings quality. Operating evidence includes customer retention, employee turnover, service quality, sales productivity, delivery performance, management depth, and the speed and accuracy of information. The two must agree. When EBITDA rises while customer complaints, employee departures, and deferred maintenance accumulate, the apparent value may be temporary. When the company invests in systems, leadership, and customer experience, near-term earnings may grow more slowly while long-term value improves. The investor's responsibility is to distinguish cost from investment and improvement from extraction. Know when to walk away. The most valuable deal in a career may be the one not completed. Fox is willing to leave when the central assumptions cannot be verified, when the seller's explanations change, when the management transition depends on hope, when financing removes necessary flexibility, or when the price requires an outcome the buyer cannot control. Walking away is difficult after months of work. Advisors are engaged, lenders are prepared, the investment team has built a persuasive case, the seller expects an answer. Human beings become attached to transactions they have worked hard to understand. That attachment is dangerous. A disciplined investment process includes pre-agreed reasons to stop. The firm should identify kill criteria before competitive pressure and sunk costs distort judgment. Fox returns to the original question: what must go right? If the list is too long, the answer is not a more elaborate model. It is a different price, a different structure, or no deal. The Grand Master's mantra: do not buy a story you cannot finance, operate, and survive. Life lesson: good judgment is not demonstrated by always saying no. It is demonstrated by knowing which risks are worth accepting, which can be changed, and which will control you after the excitement has passed. The Owner's Notebook. Before approving an acquisition, ask, what are the 3 facts that make this a good business? What are the 3 assumptions that make this a good deal? Which assumption is least within our control? How much cash does the company generate after honest reinvestment? Can the company operate without the seller? What breaks first in the downside case? Which 2 or 3 value creation levers matter most? What must be true by day 100? Does the capital structure preserve time and options? Will the company be stronger when we leave than when we arrived? Chapter 38. The Art of Knowing When to Sell. Buying receives more attention than selling because the acquisition contains the original insight. The exit determines whether the insight becomes realized value. A sponsor may sell through a strategic acquisition, another private equity firm, an initial public offering, a recapitalization, a continuation vehicle, or a partial secondary transaction. Each route serves different objectives. A strategic buyer may pay for synergies. Another sponsor may value the next stage of growth. Public markets may provide liquidity over time and allow the company to retain independence. A continuation fund may extend ownership when the sponsor believes substantial value remains. The decision should begin with the company, not the fund calendar. Has the original thesis been realized? What value remains? Which risks have increased? Does the company need an owner with different capabilities or capital? A firm may sell too early because it wants to lock in a strong IRR. Internal rate of return rewards speed. A quick double can appear superior to a larger return earned over a longer period, even if the latter creates more total wealth. The manager must balance fund economics with investor value. Partial exits can return capital while preserving upside. Selling too late carries different risks. Management may become tired. The market may change. A portfolio company may grow beyond the sponsor's expertise. Concentration can become excessive. The Grand Master does not attempt to sell at the precise top. That requires luck. She seeks a price that fairly compensates for the remaining opportunity and risk. Preparation matters. A company becomes exit-ready through accurate financials, strong management, clear growth plans, legal compliance, and evidence of sustainable performance. Cosmetic preparation in the final months cannot replace years of governance. The sponsor should also consider the next owner. A buyer whose plan depends on excessive leverage or unrealistic synergies may offer the highest price. The seller's formal duty is often to maximize value for its investors, but reputation and employee responsibility should enter the decision. Some sponsors argue that the next owner's behavior is not their concern. Legally, that may be true in many circumstances. Institutionally, it is short-sighted. Founders and management teams remember who was chosen. Future sellers evaluate whether the firm protected the company. Continuation vehicles complicate the exit question because the sponsor remains the owner while existing investors may sell. The price must be established fairly, conflicts disclosed, and investors given a meaningful choice. An IPO is not a complete exit. Lockups, market conditions, and staged sales can extend the investment for years. The company must be prepared for public governance and scrutiny. The art of selling is the art of accepting that future upside belongs partly to someone else. An investor who requires the last dollar may miss the liquidity window. The Grand Master's mantra: sell when the price recognizes much of the future, but before ownership begins depending on perfect timing. Life lesson: completion requires leaving value for the next person. A deal in which only one side can win is rarely durable. Chapter 39. Reputation is permanent capital. Private equity funds have finite lives. Reputation does not. A firm may earn fees from a transaction for years, but sellers, executives, lenders, regulators, and employees remember how it behaved during difficulty. That memory affects future access. Reputation is built in moments when the economic incentive points in another direction. Does the sponsor provide capital when the company faces an unexpected crisis? Does it disclose a problem to investors before the problem becomes public? Does it honor the spirit of management equity terms? Does it protect customers and employees when cost reduction would improve the next quarter? These choices are not philanthropy. They are part of long-term franchise value. Private equity faces structural skepticism because the sponsor can benefit while the portfolio company carries debt. Fees may be earned regardless of outcome. Executives may receive incentives unavailable to ordinary employees. Ownership is often private, reducing transparency. The industry must answer skepticism through conduct, not public relations. Responsible ownership begins with accurate language. Operational efficiency should not conceal unsafe staffing. Balance sheet optimization should not conceal extraction that weakens resilience. Strategic transformation should not conceal the absence of a credible growth plan. Employees are not liabilities to be minimized. They are participants in the value creation system. Some jobs will be eliminated in necessary turnarounds, but the process can still be honest, humane, and supported. Broad-based ownership programs can strengthen alignment, but they should not be used as reputational decoration. Employees need meaningful economics, understandable terms, and a real chance of benefiting. Reputation also requires respect for the public role of certain assets. Healthcare, infrastructure, education, housing, and financial services affect communities beyond the shareholder base. Owners should understand that regulation often follows conduct perceived as unfair. The best firms create internal standards that exceed the legal minimum. They evaluate cyber risk, safety, compliance, environmental obligations, and employee practices because these issues can destroy both value and trust. A strong reputation can function like permanent capital. It attracts founders, executives, limited partners, and opportunities. It reduces the friction of uncertainty because others believe the firm will behave predictably. A weak reputation creates a tax. Sellers demand more certainty. Executives refuse to join. Regulators scrutinize, employees resist. Limited partners ask harder questions. The Grand Master protects reputation by making it part of investment decisions, not a communications function added afterward. A transaction that produces an attractive return but damages the firm's ability to be trusted may be economically worse than it appears. The Grand Master's mantra. Reputation is the return earned on every decision no model can fully price. The Owner's Notebook. Before a difficult action, ask how it would be described by the employee affected, the customer depending on the service, the limited partner whose capital is invested, the regulator responsible for the sector, and the founder considering selling the next company. Chapter 40. The 20 Mantras of the Grand Masters. The private equity legends in this book differ in temperament, strategy, geography, and scale. Their methods cannot be reduced to one formula, yet the strongest practices repeat. 1. Buy the business, not the excitement. A competitive process can make activity feel like opportunity. Return to customers, cash flow, management, and price. 2. Leverage should support the plan. Debt can improve returns and discipline. It should not remove the company's ability to survive ordinary disappointment. 3. Winning the auction is not winning the investment. The closing creates responsibility. The outcome depends on ownership. 4. Price determines how much imperfection you can tolerate. A high-quality company can be a poor investment when the entry price requires perfection. 5. Concentration must be earned. Conviction should arise from differentiated understanding, not emotional certainty. 6. Specialization creates speed. Sector knowledge improves questions and pattern recognition. It must not become rigidity. 7. Complexity is not sophistication. The best complex investors can explain the decisive risk simply. 8. Underwrite the downside as seriously as the upside. A downside case should threaten the thesis, not merely reduce the return. 9. Time must be financed. A good long-term idea can fail if the company runs out of liquidity first. 10. Management quality is a capital asset. The plan is executed by people. Leadership assessment deserves the same rigor as financial analysis. 11. Culture is an operating system. It determines how information travels, how problems are disclosed, and how decisions are made under pressure. 12. A playbook is a tool, not a religion. Repeat principles. Adapt prescriptions. 13. Global scale is built locally. Context, regulation, and relationships cannot be centralized completely. 14. Fundraising is a covenant. Committed capital is not applause. It is responsibility for future decisions. 15. AM measures trust, not wisdom. Size expands resources and obligations. It does not guarantee performance. 16. Build value the company can keep. Durable capabilities matter more than temporary presentation. 17. Liquidity decides when patience is possible. Cash and maturity structure determine whether the owner can remain rational. 18. Reputation is permanent capital. The behavior surrounding one investment affects the next decade of opportunity. 19. Leave room for the world to be wrong. The investment should not require rates, commodities, regulators, competitors, and customers all to cooperate. 20. Ownership is stewardship. Control gives the investor power over an enterprise that affects people who did not negotiate the transaction. These mantras are useful only when converted into process. A firm should reflect them in investment committee questions, compensation, portfolio reviews, and promotion decisions. The culture of an investment organization is revealed by what happens when a mantra conflicts with a fee, a deadline, or a desired deal. That is where principle becomes real. Chapter 41. The investor you become. Private equity is often presented as a path to wealth, influence, and exceptional achievement. It can be all three, but the industry also shapes the people who practice it. The work rewards skepticism, urgency, competitiveness, and control. Those qualities are useful in transactions. Unchecked, they can narrow a life. An investor may begin to see every relationship as a negotiation, every company as an asset, and every hour as an opportunity cost. Success can make listening harder. Wealth can insulate judgment from consequence. The grandmasters are distinguished not only by what they acquire, but by the disciplines they preserve while acquiring it. Curiosity prevents experience from becoming certainty. Humility allows new evidence to change a view. Patience protects the investor from the need to act. Courage permits action when the evidence is sufficient, but comfort is absent. Integrity protects the institution when a profitable shortcut appears. Private equity offers a unique education because it connects ideas to consequence. A thesis becomes a company strategy. A financing decision affects hiring. A board decision affects customers and communities. The investor cannot remain entirely theoretical. This creates the opportunity to become a better steward. A steward treats capital as something entrusted rather than possessed. She understands that limited partners have obligations of their own. She respects the people who built the company before she arrived. She recognizes that employees contribute knowledge and effort that no purchase agreement can fully value. Stewardship does not prohibit hard decisions. Companies sometimes need restructuring, leadership change, or closure. The difference lies in honesty, proportionality, and whether the owner has exhausted better alternatives. The best investors also know when enough is enough. A firm does not need to raise every larger fund. A person does not need to win every negotiation. An owner does not need to extract every dollar. Restraint is difficult because markets celebrate visible expansion. Yet many of the industry's greatest failures began when successful people believed prior success entitled them to greater risk. Legacy is not the list of transactions completed. It is a set of institutions, companies, and people made more capable through ownership. The future of private equity will include larger pools of capital, more private credit, artificial intelligence, sovereign investment, retail participation, and deeper involvement in essential infrastructure. The industry's decisions will affect more lives. Its leaders will need technical skill, but technical skill will not be enough. They will need judgment about responsibility. At the end of an investment, the numbers will show what was earned, the company will show what was built, the people will remember how ownership felt, and the investor will have become the sum of the decisions made when no rule required the better choice. The final mantra. The highest return is not merely capital multiplied. It is capability, trust, and value left stronger than you found them. Afterward. The Owner's Mandate. By Anderson Fox. Ownership is easy to romanticize from a distance. The announcement is public, the photographs are polished, the purchase price is repeated. The real work begins when the room becomes quiet and the company looks to its new owner for direction. An owner has 3 obligations. The first is to see the truth, not the seller's truth, the lender's truth, the management presentation, or the story required to justify the price. The owner must see the business as it is. The second is to create capability. Capital alone does not transform a company. People, systems, standards, and courage do. The owner's role is to help the enterprise become able to do what it could not do before. The third is to accept consequence. Control means that decisions reach beyond the investment committee. They affect families, customers, suppliers, communities, and future owners. Private equity earns legitimacy when it builds companies worthy of the capital entrusted to them. It loses legitimacy when ownership becomes extraction without stewardship. The next generation of investors has an opportunity to practice a more complete form of ownership: financially rigorous, operationally serious, technologically capable, and humanly responsible. That is the mandate. The Grandmaster's Acquisition Scorecard. Use a score from 1 to 5 for each category, then write the evidence supporting the score. A number without evidence is decoration. Business quality, revenue durability, customer concentration, customer retention, competitive differentiation, pricing power, market growth, capital intensity, cash conversion. Management and organization, chief executive quality, leadership depth, financial controls, sales management, operational discipline, talent retention, succession readiness, culture, and information flow. Transaction quality, entry valuation, financing flexibility, liquidity reserves, covenant headroom, seller alignment, management equity design, legal and regulatory risk, exit alternatives. Value creation credibility, organic growth initiatives, pricing opportunity, margin improvement, working capital improvement, technology and data, acquisition pipeline, leadership upgrades, international expansion. Downside resilience, cyclicality, customer loss scenario, interest rate sensitivity, refinancing risk, commodity exposure, regulatory exposure, litigation and compliance, ability to continue investing during stress. Stewardship, employee consequences, customer consequences, community and public interest obligations, safety and quality, environmental liabilities, reputation risk, condition of the company at exit. The investment committee's 20 questions. What is the single most important reason this company is valuable? Why is the seller willing to sell now? What do we believe that the market does not? Which fact would cause us to abandon the deal? What percentage of the return depends on multiple expansion? How much value comes from leverage rather than business improvement? What happens if revenue is 20% below plan? What happens if the exit is delayed 3 years? Which customer, employee, or supplier concentration is understated? What capital expenditure has been deferred? Which member of the management is indispensable? What will competitors do after we close? Which initiative has the highest execution risk? Does the company have enough liquidity to remain rational? What is the most credible alternative use of the capital? Are incentives aligned across the sponsor, management, employees, and lenders? How would a skeptical customer describe the company? What will make the business more valuable to the next owner? Who bears the cost if the thesis fails? Would we be comfortable owning the company for 10 years? A Plain English Guide to Private Equity Returns. Multiple on invested capital. MOIC measures total value relative to invested equity. If an investor commits $100 million and receives $250 million, the gross MOIC is 2.5 times. MOIC does not show how long the investment took. Internal rate of return. IRR estimates the annualized return based on the timing of cash flows. Receiving money earlier generally increases IRR. A 2 times return in 3 years has a higher IRR than a 2 times return in 8 years, even though the multiple is the same. Gross and net returns. Gross returns are calculated before management fees, carried interest, and certain expenses. Net returns reflect the investor's result after those costs. Realized and unrealized value. Realized value has been distributed or received in cash or securities. Unrealized value remains based on the estimated value of investments still held. DPI, RVPI, and TVPI. DPI measures distributions relative to paid-in capital. RVPI measures remaining value relative to paid-in capital. TVPI combines distributed and remaining value. Why comparisons are difficult. Funds differ by vintage year, strategy, geography, currency, leverage, valuation policy, and timing. A single performance number should never replace full attribution. Introduction and Prologue. Electronic Arts Inc. EA announces agreement to be acquired by PIF, Silver Lake and Affinity Partners for $55 billion. September 29, 2025. Electronic Arts Fiscal 2026 earnings release and SEC filings concerning the pending transaction. Blackstone first and second quarter 2026 results and firm overview. Apollo Global Management first quarter 2026 results. Brookfield Asset Management first quarter 2026 materials. KKR Investor Materials. Carlyle and EQT corporate reports. Chapters 1 to 5. Public histories of Kohlberg Kravis Roberts. U.S. Securities and Exchange Commission filings. Contemporary reporting and historical accounts of management buyouts, RJR Nabisco, and the development of leveraged finance. Chapters 6 to 12. Blackstone firm history and 2026 financial results. KKR corporate history and ownership culture materials. Apollo corporate history and 2026 results. Carlyle corporate history and 2026 AUM disclosures. CVC Fund 9 announcement. EQT 2026 reports. Advent, Bain Capital, and TPG public firm histories. Chapter 18. Blackstone and Private Equity International materials concerning Hilton, Hilton public filings and corporate history. Published return estimates vary by methodology. Chapter 19. HCA public filings, transaction materials, and sponsor disclosures concerning the 2006 acquisition and later public offerings. Chapter 20. Energy Future Holdings bankruptcy records, TXU transaction materials, and public accounts of the company's restructuring. Chapter 21. Atlantia and Adesione transaction announcements, Blackstone materials, Mundy's corporate information, and public records concerning the Morandi Bridge collapse and subsequent governance changes. Chapter 22. Walgreens Boots Alliance transaction materials and SEC exhibits, Sycamore Partners completion announcement dated August 28, 2025. Chapter 23. Electronic Arts September 29, 2025 merger announcement, SEC filings, antitrust status filings, and fiscal 2026 financial results. The transaction was described as pending in the most recent company materials reviewed for this edition. Chapters 24 to 30. CVC Fund 9 closing announcement, Private Equity International's 2026 into 300 methodology and ranking, official 2026 AUM disclosures from Blackstone, Apollo, Brookfield, KKR, Carlyle, EQT, CVC, and other firms. official biographies and firm materials for Jennifer James, Catherine Petty, Sylvia Oteri, and Gabrielle Rubinstein. Chapter 37. This chapter draws on biographical and professional information supplied for this edition concerning Anderson Fox, including his work in mergers and acquisitions, corporate finance, private equity, and strategic ownership, together with the deal analysis and value creation principles attributed to him. It emphasizes underwriting process, downside discipline, transferability, operating improvement, and shareholder value creation rather than unaudited transaction performance claims. Chapters 31 to 41 and appendices. The analytical frameworks are the author's synthesis of private equity practice, governance principles, transaction analysis, operating experience, and the public record described above.